Good morning, everyone. My name is Jason Gold with I'm a senior fellow at the Progressive Policy Institute and the director of our housing initiative. First order of business, I want to congratulate the Washington Nationals for clinching the division last night. So I wanted to first thank Doug Holtzik and his group at American Action Forum with working with us. Cameron, Andrew, Sarah, they're all just a first-rate bunch, and they've made this really well. And we really enjoyed working with them. You know, when I came to Will Marshall, our president, a little over a year ago, about starting a housing initiative, there are three things we really wanted to accomplish. One, we wanted to identify the housing markets as essential to not only economic recovery, but to economic growth. Two, we weren't satisfied that the public and private sectors had been able to come together to offer a really effective remedy to the heart of the problem of housing, which we believe is negative equity. And to us, it's really a matter of fairness. And three, we wanted to create a model to restore and protect the value of the middle class's largest asset. We really are focused on building a stable model for long-term investment and not really just a playpen of speculation. So that's kind of how we have looked at that, and hopefully we will broach many of those subjects and work on them today and talk about them. And we have brought together some of the top experts, policymakers, academics, and thought leaders in the world of housing and economics. But we're going to start with a few remarks from the Secretary of Housing and Urban Development. Secretary Donovan has had a long and distinguished career in the housing community. This is his second go-around at HUD after his previous experience as Deputy Assistant Secretary in the Clinton administration. He has worked in the private sector and most recently returned to HUD from his role as Commissioner of New York City Department and Housing Preservation and Development. And with that, it is my pleasure to welcome the Honorable Shaun Donovan.
Thank you. Good morning to all of you. Jason, thanks for the introduction. Go Yankees. Sorry. Couldn't help myself. I also want to thank Will and everyone here for inviting me today. And you're really going to focus today for the remainder of the gathering to discuss how to build on the improvements that we've seen in our housing market, the steps that we need to take to bring private capital back, and some of the decisions we face in building the next generation of housing finance. These are some of the most consequential decisions we'll make in the coming decade, with broad implications not just for housing, but for wealth creation, our communities, and our economy. And so with my remarks this morning, I wanted to provide some context for that discussion. A survey of the administration's response to the housing crisis that has brought us to this point. To begin with, as we speak, our housing market is showing important signs of recovery. The number of families falling into foreclosure is half what it was in the early days of the administration. We had the strongest year of home sales since the crisis began, with housing construction growing faster than any time since 2008. And home prices are on the rise, with the Case-Shiller Home Price Index up year over year for the first time since September 2010. Let me see if I can get this right. Combined with an increase in principal reductions, the Fed reports that $860 billion in home equity was created in the first 6 months of 2012, and likely over $1 trillion so far this year, given the continued improvements in home prices we've seen since then. CoreLogic reports the growth in home equity helped lift 1.3 million families above water in the first half of this year, a reduction in the number of underwater families of about 11%. There is, of course, much work that remains to be done, and there are headwinds that could yet stall our early momentum. But it is important to take stock of where we are and how far we've come since 2009. I want to describe the approach we took in the earliest months of the administration. I want to talk about the barriers that we have faced, the lessons we've learned, and how, as a response, our approach has evolved. Finally, I want to share with you how the work we've done helps frame the fundamental tensions that I see anchoring the debates we still need to resolve in order to bring our housing market to a more complete and lasting recovery. First, I want to discuss the initial interventions we made to keep homeowners in their homes and our housing market afloat, and to highlight what they accomplished in the president's first year in office in particular. Obviously, this was a desperate time for our economy, with more than 800,000 jobs lost in the month President Obama was sworn in. Foreclosures, of course, were setting record levels month after month. And after peaking in August of 2006, house prices were in free fall, dropping every month for 30 straight months. They would end up falling by nearly a third in that time, and were expected to decline by another 17% by the time President Obama served his first year in the White House. First, we focused on credit. Obviously, there's been a great deal of attention, particularly recently, on the Fed's actions to keep interest rates low. But often missed in this discussion is the fact that low interest rates are only meaningful to housing if mortgage credit is available at those rates. That's why the administration's work to support Fannie Mae and Freddie Mac was critical, because it sent a clear signal to the market that the GSEs would have support. Our support for the Federal Housing Administration was also critical, playing a historic countercyclical role, one it has only been called upon to fulfill a handful of times in its existence. Few analysts have focused on this, but Mark Zandi has it exactly right. Without FHA, quote, the housing market would have completely shut down, end quote, and it would have taken the economy with it. Second, we focused on demand. At a time when there was so much uncertainty in the market, the Recovery Act's extension and expansion of the first-time homebuyers tax credit gave potential buyers a sense of urgency when it came to purchasing a home. Third, we provided help for distressed homeowners and neighborhoods. The Home Affordable Modification Program, or HAMP, is often described as not living up to expectations. But that was not the initial indication that we had. At a time when the wave of foreclosures seemed almost irreversible, HAMP, a completely new program and the largest modification effort in 75 years, reduced payments for 1 million people in its first 9 months. Helping 1 million families who otherwise would have gone into foreclosure almost immediately wasn't all that HAMP accomplished in its first year either. In those early months, we also saw the program's other big impact, how the HAMP template changed the way proprietary modifications were done. It's almost hard to believe today, but before HAMP, about half of proprietary mortgage modifications done by banks actually increased payments for borrowers. Today, the OCC reports that 90% of all proprietary modifications reduce payments. As a result, not only have HAMP modifications performed better than widely expected at that time, with only a 1 in 5 redefault rate, but proprietary modifications have improved as well. This increase and improvement in proprietary modifications also accounts for another misunderstood feature of HAMP. Even though there's been a lot of focus on the number of families who either didn't qualify for HAMP or fell out of the HAMP program, in reality, only about 20% of families who didn't qualify for HAMP ended up in foreclosure. That is in large part because a significant share of families who didn't qualify for HAMP were ultimately able to qualify for a private modification that enabled them to keep their homes. This is a big reason, as our latest housing scorecard shows, that while about 3 million families went through a foreclosure after HAMP was launched, nearly twice as many, 5.6 million, have gotten the help they need to save their homes with average payment reductions of about $380 a month, according to the latest data from the OCC. I would also note that help for homeowners wasn't the only relief that we provided. We also made available the second of what would be 3 rounds of funding to distressed neighborhoods through the Neighborhood Stabilization Program, which is on track to address about 95,000 properties. Compared to 3 million foreclosures, 95,000 properties may seem small, but it represents about a quarter of the REO in our hardest hit places. And these tools now have a proven record of rebuilding not just neighborhoods, but home prices. In fact, data shows that 3/4 of places that have received targeted investments through the first 2 rounds of NSP showed increased home prices relative to surrounding neighborhoods. Indeed, it's been successful enough that the President believes we should build on this effort with a new Project Rebuild, part of the American Jobs Act, that would scale neighborhood stabilization up dramatically and create 200,000 jobs in these hard-hit places. Now, as we assessed all of these efforts during the President's first year in office, there was evidence that the work we had done in the housing market was having an impact. Home prices in 2009 didn't decline by another 17% as forecasters were predicting. In fact, they started rising in the spring and were up for the next year. This slide shows what house price futures looked like at the time the president came into office, with the expected decline during that first year, and what actually happened to home prices over time. And in addition, foreclosure notices and later delinquencies began what would be a long trend downward. But as that year progressed, we also increasingly understood that there were a number of barriers and challenges that would stand in the way of our housing efforts, barriers that forced us to look at our efforts and reassess whether they would succeed. The first barrier was one that had become increasingly clear as the campaign and the transition progressed: unemployment. For housing, that meant the problem was shifting more and more from one of bad loans, subprime and predatory loans, to one of joblessness and underemployment. The second barrier to recovery we were facing, as I alluded to earlier, was the capacity of HAMP servicers to implement it and the over-design of the program itself. This left increasing numbers of families dropping out of the program and fewer families qualifying after the initial surge of trial modifications. The third barrier was complexity and conflicting incentives. The dozens of different institutions who owned a single mortgage, not to mention subordinate debt or mortgage insurance, that existed within our finance and securitization system without clear rules of the road you need when a homeowner faces a crisis. The fourth barrier was negative equity. In the long run, we understood that we needed to reduce the number of people who owed more on their mortgage than their home was worth in order to fix what would be the longest lasting legacy of the crisis. Which brings me to the fifth and final barrier: the simple fact that the federal government at the time had limited tools to change the behavior of lenders and servicers. As evidence emerged that banks lacked capacity and were stymied by the complexity and conflicts of our finance system, and that principal reduction would increasingly become critical to providing families with a light at the end of the tunnel, we lacked the authority to establish those rules of the road independently, and it would be difficult for Congress to act to establish them. As a result of these barriers, which were often interrelated, what appeared to be the beginnings of a broader recovery in our economy and housing market stalled, a fact that became especially clear with the expiration of the homebuyer tax credit in mid-2010. So in the next few minutes, I want to talk to you about how we went back and looked at our efforts, reassessed them, and describe how they evolved in response to these barriers. First, we adjusted our approach to deal with the increasing length and depth of unemployment. As we were implementing the Recovery Act and the President's Auto Rescue, which saved more than 1 million jobs up and down the supply chain, we recognized that we needed a more robust strategy to help the unemployed stay in their homes. At the time, 60% of the unemployed were out of work for more than 3 months, and 45% were out of work for more than 6 months. And while our initial HAMP design included a provision for unemployment forbearance that would help folks whose histories of unemployment and good credit before the crisis hit would likely resume once the worst of the storm had passed, we realized that we needed to strengthen that provision. That's why we extended the forbearance provided through FHA and HAMP to 12 months to bring it more into line with how long it took for folks to find a job in this crisis. And within weeks of these actions, the industry began to follow suit, broadly adopting our standard and allowing families searching for work to catch up on payments. To address the second barrier, the over-design of HAMP and capacity of its servicers, we simplified the program, ramped up our oversight, and made more people eligible. Underappreciated in all this was that we also continued to ramp up investment in housing counselors, proposing record-high funding in the President's budgets. HUD-approved housing counselors have helped more than 8 million families since President Obama took office. And with a recent HUD study showing that 7 in 10 at-risk homeowners who worked with a housing counselor got the help they needed to keep their home, it's clear that housing counseling works. That's one reason we urge states to use the payments that they receive from servicers as part of the national mortgage settlement to fund housing counseling efforts. And as of now, states have committed nearly $250 million to housing counseling, making it one of the single largest counseling investments in history. Funded, I would note, not by the taxpayers, but the institutions that created such a demand for these kinds of services, the banks themselves. Let me turn now to the third barrier I described, the complexity and conflicting incentives in our system. Perhaps the best example of these challenges is in the HARP program, which intended to open up refinancing to underwater Fannie Mae and Freddie Mac borrowers. As we implemented the program, we found a series of problems, such as second lien holders and mortgage insurers, that were blocking the refinancing of first mortgages even when a lower payment would seem to benefit the likelihood of their own repayment. As a result, at this time last year, HARP was responsible for less than 1 million refinances, even as interest rates hovered below 4%. That's why the President charged us to make big changes to HARP, and by sitting down with lenders, mortgage insurers, regulators, and investors to address these challenges one by one, we did just that. Since that time, we've seen a 160% increase in total volume. More than 1 million families have applied, and more than 500,000 refinances had closed by the end of July, saving these families on average $3,000 per year. The changes have been most dramatic for families who are deeply underwater, where not a single conventional mortgage borrower with a loan-to-value over 125% had been able to refinance before these changes went into place. In June and July alone, there were 81,000 refinances for these borrowers. That's a big reason the overall increases in refinancing have been most significant in hard-hit states like Florida and Nevada, by 175% and 260% respectively. We also dramatically cut fees for FHA refinancing, allowing families to pay minimum fees to refinance into a new FHA-insured loan. And in just the first 3 months, we saw a more than 200% increase in applications. Even with refinancing at a 3-year high, however, as you know, we're now pushing for action on the President's proposal to allow every family current on their mortgage to refinance and rebuild what they've lost. Another 8 million borrowers would be eligible to benefit under HARP with the Menendez-Boxer legislation, which would clear the remaining barriers to refinancing for homeowners with loans backed by Fannie and Freddie. And another 3 million borrowers whose loans are not guaranteed by the government would be eligible under legislation proposed by Senator Feinstein. Just as our work to support the GSEs in the earliest days of the administration was essential to ensuring the Fed and Treasury's actions to keep interest rates low boosted our housing market and economy, getting the maximum impact from the Fed's recent QE3 action depends on passing the President's refinancing proposal and allowing more than 10 million additional Americans the opportunity to refinance. We've also begun to make progress addressing the fourth barrier to recovery, negative equity. As I mentioned, 1.3 million families were lifted above water in the first 6 months of the year. Refinancing initiatives and low interest rates can help as well if homeowners who refinance apply those savings to paying down principal more quickly, a choice that an increasing number of families are making. And families would have additional incentives to do just that in Senator Merkley's Rebuilding Equity Act. But refinancing alone won't help the most deeply underwater homeowners who have no light at the end of the tunnel and are struggling to make their payments. That's one reason why the historic $25 billion settlement the administration and 49 state attorneys general struck with the 5 largest servicers earlier this year was so important. Early results indicate that roughly 165,000 families have received $14 billion in relief so far. What has made this relief as significant is that the banks are actually writing down permanently, on average, more than $105,000 in mortgage debt. Now, some critics of the settlement have said that the amount of principal reduction we're going to see with the settlement is small compared to the problem. But the settlement was never supposed to act alone. Indeed, it builds on changes we made to HAMP at the same time we were finalizing the settlement earlier this year, which tripled incentives to investors. As a result, more than 3/4 of non-GSE homeowners entering HAMP now receive a principal reduction averaging about $70,000 per year. Further, recent data from the OCC shows a 75% increase in loan modification trials outside of HAMP in the second quarter of this year. As those trials become permanent, we expect third quarter data to show a substantial increase in principal reduction. Ultimately, our hope is that principal reduction becomes the standard approach for deeply underwater homeowners struggling to keep their homes. The settlement was also critical with respect to addressing the fifth and final barrier I mentioned, our inability to require servicers to act. One of the most important revelations of the so-called robo-signing scandal was that many of the same institutions who got us into the crisis had not only learned its lessons, but were actually making it worse. The settlement gave us a tool to require principal reduction and other steps at a time when Congress would not. What has gotten less attention, but in the long run will be equally as important, is the comprehensive servicing standards it committed the servicers to that go into effect today. These include fundamental reforms like preventing a bank from foreclosing on a home at the same time that a family is awaiting a modification, as well as customer service improvements like an online portal where homeowners can securely upload documents and a single point of contact for homeowners seeking help. These standards build upon the lessons of HAMP as well as the new protections introduced when the President announced the Homeowner Bill of Rights. Perhaps most important of all, the Consumer Financial Protection Bureau, created by the Dodd-Frank Wall Street Reform Act, is in the process of making these reforms rules of the road that will apply to not just the 5 banks party to the settlement, but to the entire mortgage servicing industry. And so, this morning I've laid out the ways our strategies have evolved and strengthened over the course of the last 4 years. And while a fuller evaluation will need to be done by economists and historians with greater analysis and the perspective of time, and, to be clear, despite the fact that our progress has not been made in a straight line, it's clear that housing is stronger than most had expected it to be at the time that the President took office. Again, I would go back to what were the expectations in the market of what would happen to housing over this time. And what you clearly see is that it wasn't a straight line, that there were challenges along the way. But today, housing is in a significantly better position, by this measure, home prices, than most analysts and the market expected at that time. Now also, obviously, there remains a lot of work ahead in continuing to recover from this crisis, which still has too many families at risk of foreclosure, too many neighborhoods struggling. But we also need to focus, as you are today, on continuing to rebuild our housing finance system and to ensure that a crisis like this never happens again. And that brings me back to the rest of today. The fundamental tension in most of the issues you'll be discussing is how to create rules of the road without stifling competition and entrepreneurship or impeding access to mortgage credit. To take one example, the current debate about what constitutes a so-called qualified mortgage or qualified residential mortgage. There are some who look at today's market and see that the broader underwriting requirements proposed under QRM would have limited impact on today's lending. And the conclusion they draw from that is that we need a narrower definition. But the loans we should be looking to limit aren't the safe loans being made in today's tight market, but those that were being made in the midst of the bubble. For instance, less than 15% of the loans being made in 2006 would qualify under even the broader definitions that are being considered for QRM. We need to remember that the goal of this debate is not to limit credit further from today, but rather to ensure that the kind of access we're encouraging doesn't cause another crisis. Another debate is the proper role of government, and particularly the guarantees that it provides in the market. As we've made clear, this administration believes that private capital needs to come back and that government's footprint in the housing market needs to be much smaller. This crisis has exposed the fundamental flaws in the model of the GSEs, from inadequate capital standards to a profit-maximizing structure that undermined their public mission. These criticisms and others were laid out clearly in the administration's white paper. But at the same time the crisis has exposed those flaws, it's also demonstrated, as Mark Zandi has as well, that the government can play a key countercyclical role in supporting the market as private capital pulls back. These are the tensions that you'll be discussing today. Bringing private capital back and reducing government's footprint while also preserving the fundamental role of credit support and liquidity in what is the second largest securities market in the world. With a clear understanding of recent history, of what's worked, what hasn't worked, and why, my hope is that you'll help steer these conversations in a constructive direction that builds on our progress, that understands we need to harness the vitality, innovation, and creativity in our system in a responsible way, and that ensures the responsible access that was once the hallmark of our housing market and is a cornerstone of the middle class. It's a tall order, but based on our progress so far, one I believe that we can meet together. So thank you for the opportunity to join you today. Enjoy the rest of your discussion. Thank you.
Thank you, Mr. Secretary. For the next portion, the next segment, we're going to have Stan Humphries, Chief Economist from Zillow, and Paul Willen, Paul, from the Boston Federal Reserve, come up and go through some housing data.
Great. We take a seat before we get started, or? Okay. Oh, okay. Great, thank you very much, Jason. I'm Stan Humphries from Zillow, Chief Economist. I'm going to be talking a little bit about kind of where we are right now in terms of the market, and a little bit about our expectations for what we're going to see over the next few years as well. With that in mind, I thought I'd start out generally looking at, before I turn to home sales, looking at home values themselves. So what you're looking at here is Zillow's Home Value Index, which is an index constructed that excludes foreclosure resales. So our index is designed to give consumers an idea of what's happening to home values over time, with the expectation that consumers are looking at selling their homes in a full value arm's length transaction. So we exclude foreclosure transactions from that, and it's a index which is fairly comprehensive. It covers about 85 million homes across the U.S. And according to that index, so once you kind of get out of the Case-Shiller 20 and start to look at really the broader U.S. market, you see an actual a little bit less of a overall decline in home values than you would be implied from looking at the Case-Shiller 20 market index. So in our index, we're down about 21.5% from peak. Our peak on our index is in about mid-2007. Peak to trough, you can see that from this line here, we're a little bit off of our trough levels, which the trough was in late 2011. And peak to trough is about 22.5%. So we're up off of our trough levels in terms of home values. And we believe at Zillow that we have, in terms of home values, hit a bottom. We believe that the bottom was late last year, early part of this year. Generally, our expectations and our characterization of the market, we've tried to be as accurate as we can about what's happening in the marketplace, and that's tended to put us more on the bearish side in terms of outlook over the past 4 or 5 years. And I would say that at this point, we are feeling pretty confident that a bottom is in place in home values, and that this bottom in terms of home values is sustainable at this point for a number of reasons, which I'm going to outline next. Actually, if you convert the line that I was just looking at previously to month-over-month and year-over-year trends, you can see kind of what that looks like in terms of currently we are up annually from where we were last year, so up 1.7% home values are. In addition, this is August data you're looking at here. So between July and August, we did have a slight blip down, about 0.1% decline in home values, but for the previous 9 months before that, home values had seen 9 consecutive months of monthly gains. So we think that, and it's important to remember the period of time over which those gains were occurring, which was a period of time in which we did have, so like 2010 and 2011, we came into 2012 like gangbusters in the housing market. Home sales had already started to pick up in December. We're doing quite well through the January and February timeframe. We were also having, of course, robust job creation in the first quarter of this year. And of course, we had a little bit of weakening in job growth numbers in the second quarter, which is something we had seen as well in 2010 and 2011. So we were very eager to see our Q2 2012 numbers. And indeed, the housing market actually did quite well in the second quarter, giving us further confidence that what we're seeing in the housing market right now is being driven by organic fundamental demand in the housing market, not driven by federal home buyer tax credits in the case of 2010 or other ancillary elements of the market. So we feel pretty good that what we're seeing is being driven by fundamentals at this point. In terms of what we think has contributed to finally getting home buyers off the fence. I guess I should say I'm going to address affordability in another couple of slides, but affordability has been incredibly low for the past year and a half to 2 years. I think the real conundrum in the housing market has been why, given such incredibly high levels of affordability, have we been unable to get home buyers off the fence unless we were paying them up to $8,000 to buy homes. Why has that been? And of course, the key, probably the two biggest reasons have been general economic uncertainty out in the marketplace has kept buyers off the fence, particularly high levels of unemployment, as well as the fact that home values themselves were still falling so quickly on a monthly basis. So both is what's bidding up prices, rental prices right now. Nationally, in August, we show rents up more than 5% year over year, so still very aggressive rental appreciation there. In terms of what this has done to affordability, a couple of different ways. Actually, a few different ways we're going to look at affordability in the next couple of slides. One is looking at price to income ratios and affordability. So price to income is just looking at the home value of the house relative to the median household income, and that's the blue line. The top chart here is what you're looking at here, where the blue line, the value that we're looking at for homes is actually the median value of all homes. So here you can see dramatically the signs of the bubble in the middle part of the last decade, and then of course the tremendous housing recession we incurred after that. You can also see, importantly here, that actually looking at the entire housing stock, so if you look at the median value of every house out in the United States and compare that to the median income, the median household income, we're still slightly above the long-term trend which prevailed between 1985 and 2000. You get a different picture if you actually look at median sale price relative to median household income, and that's because typically the median sales right now have been lower than the overall value of homes out there, meaning that what's selling is actually not a representative view of the overall housing stock. But the picture, suffice it to say that even on a price to income basis, we are substantially back down into the neighborhood of reasonableness on that metric. And then it really gets even much rosier once you crank in the impacts of mortgage rates, with mortgage rates being below 4% right now. Once you crank that in, that's the orange line on the bottom, on the bottom of this chart, where you can see that currently we're trending about 35% below our 15-year average that prevailed between 85 and 2000, where the total financing cost, basically what people are going to spend on housing, generally trended around 20% during that 15-year period, and is now well below that. Currently, we're tracking in the second quarter of 2012, 13% is what the median household income is paying on a typical mortgage right now. I should also note that the blue line would actually have improved quite a bit substantially. It would have improved quite a bit more if we had not had a little bit of lagging growth in incomes themselves, which didn't help improve the blue line. So we had a tremendous decline in home values, but we also had some stagnation in the median household income numbers as well. These trend lines get even more dramatic as you actually look at specific markets. So here, if you look at the Miami market, you can see a tremendous price to income bubble there. Affordability is now reset, is now overcorrected in terms of affordability. Phoenix, on price to income and affordability have been completely reset, and affordability is dramatically been overcorrected in Phoenix. And then in Detroit, where you've had overcorrection on both metrics, price to income and affordability. So tremendous resets in the Detroit market. Another way that we could look at it is, instead of price to income, look at it relative to prevailing rents in the marketplace as well. And what this chart is showing us is basically price to rent ratios, but we're looking at it relative to, we compute it as what we call a break-even horizon, which is how long do you need to live in a house in a given market before buying becomes more financially advantageous than renting. You can see that in most parts of the country now are green, meaning that that number is somewhere between 2 to 4 years. In fact, 75% of the United States right now has a break-even horizon of under 3 years, meaning that typically, there used to be an old conventional wisdom in the real estate market of, if you're going to, people know that if you're going to live in a house for 20 years, you ought to buy it. They also know if you're going to live in a house for a year, you should rent it. They didn't quite know when those lines crossed, and typically, the old conventional wisdom would be, 3 to 5 years. If you're, less than that, then rent. If more than that, buy. Right now, for 75% of the country, it's under 3 years. Buying makes more sense at that horizon. So places like Detroit, that break-even horizon is 2 years, meaning that if you're going to be in a place for 2 years, you should buy a home in Detroit versus rent it. In terms of looking forward, what we expect home values to be doing in the go-forward period. So I guess the good news is that we believe that in terms of home values, we are at a bottom, and we believe that bottom is sustainable. And we think that is driven by fundamentals of primarily just very high affordability levels right now. I guess our outlook for what that bottom, now that home values, we believe, have stopped falling, what happens next? There, I think our expectations are a bit more muted, not quite as bullish as others. We believe we're in for essentially a very long flat bottom, where we will see a period of, we think, 2 to 4 years of fairly modest home value appreciation. By fairly modest, I mean in the 1 to 3% range annualized nationally. Our forecast here was for the period from June to June of 2012 to 2013. And our national forecast called for 1.1% increase in home values over that period of time. You can see there are some markets that are distinctly not seeing an L-shaped recovery. That's like Phoenix and Miami there. We're expecting 10% and 6% increases over the next year. Phoenix already, we're recording home value increases over the past year of 19%. So there's clearly something unique happening in some of these hard-hit markets. In terms of, these were what I was addressing previously, were our empirical-based forecast. We also, Zillow sponsors a panel of about 140 economists, which provide their inputs, their expectations about home value trends over the next 5 years as well. Here, their expectations are registered relative to the Case-Shiller National Index. And you can, the black line is the current expectations of the panel of economists over the next 5 years. The green line is the most optimistic quartile of those economists, and the red line is the most pessimistic quartile of those economists. And you can see that the median values, the black line, is basically over the next 5 years, they believe cumulatively we'll see an increase of about 15% in home values over the next 5 years. The straight line that goes through there is actually the trend line of home value appreciation that prevailed prior to the housing bubble. And you can see that the expectation among the economist panel is below trend for that period of time, which again fits in with our expectation of kind of more of a muted home value appreciation environment near term. That having been said, the expectation of the panel of economists has been improving. These are the expectations over the next over the next 4 years by when the expectation was recorded, and the black line is the most recent reading from the panel, and you can see that it's up substantially from the orange line, which was their expectations just 4 months ago. So economists are feeling more bullish about where the overall housing market is headed. As I noted, our thesis of a long flat bottom, the primary a key feature of the housing market that colors that expectation around what's going to happen to home values is really negative equity. This is a map of negative equity at the county level across the United States. Our method of computing negative equity combines an estimate of every home value in the United States with the outstanding mortgage balance that we obtain. We partner with TransUnion, a credit bureau, to obtain the actual current outstanding mortgage balance on each home in the U.S. and pair that with the valuations themselves. And using this methodology, we actually obtain a fair bit higher estimate of negative equity across the U.S. housing stock right now than other estimates. Our estimate is, as of the second quarter, roughly about 30% of homes with mortgages were in a negative equity condition. And that is a little bit higher than other estimates. We think likely because of better accounting for the home equity lines of credit and non-first lien mortgages in the housing market, which ends up, if you underestimate that, you tend to underestimate how much negative equity there is out there. But to coalesce that heat map into numbers that actually probably make a bit more sense for the metropolitan areas, you can see that negative equity rates are extraordinarily high. The Florida markets are generally hovering around 50%. Vegas market, almost 70% of homes are in negative equity. Phoenix at 52%. So, extraordinary high levels of negative equity. And I think that the negative equity generally, I think, in most of our calculations internally over the past few years is generally, it gets conjured up in terms of our calculations more on the demand side in the past few years. We think about negative equity inhibiting demand because people can't go out and buy new homes. What we're beginning to see now, though, and having a better appreciation for, is the fact that not only does it have negative equity have demand side implications, but it also has supply side implications, which we're now seeing quite acutely in hard-hit markets like Phoenix and Miami, where we're seeing inventory dry up substantially in these markets. And what you're looking at here is on the x-axis is the percent of homes, the negative equity rate, the percent of homes that are in negative equity out of all the homes in the housing stock in that market. And then on the y-axis, the vertical axis, you're seeing the percent change in inventory of for sale homes over that time. So what you can see here is that homes that have had the biggest decline in for sale inventory, so huge drops in what's in availability of homes for sale, are also those homes that have had the highest levels of negative equity. So what we think we're seeing here is the fact that is really the supply side implications of negative equity, that people are trapped in their homes now through negative equity and can't sell their homes in order to go into the next home. And despite 19% appreciation in Phoenix, where presumably there'd be a fair number of sellers who'd want to sell into that market, we're just not seeing supply come into the market like we would expect, and we think it's because people are trapped in their homes and can't sell can't sell for the new home buyers that are entering the market, and therefore can't move up themselves. This is basically looking at the Phoenix market and differentiating it by price tiers. You can see that the bottom tier has seen the biggest change in for sale inventory over the past 1 year, and it's also seeing the highest increase in home values in that tier relative to the top tier, which is the green dot over in the far right. Bottom tier is seeing about 2% appreciation a month right now. Inventory in that tier of the housing stock is down 65% from where it was last year. So just a tremendous emptying of that marketplace on the low end, and prices are being bid up because homes aren't there. We think in markets like Phoenix and Miami, this is going to lead to, instead of that L-shaped kind of flat recovery I described before, we're expecting more of a staircase recovery where, as I mentioned, 19% annualized appreciation in Phoenix. There's no fundamentals that's driving that. In terms of fundamentals, I mean long-term fundamentals. We're not seeing income growth of 19% in Phoenix. We're not seeing in-migration of the population to support that. This is clearly more of an artificial environment driven by negative equity, a lot of investor demand in that market. We do expect that to cool, and that will be the formation of what we characterize as a staircase recovery in markets like Miami and Phoenix, where we'll see burst of home price appreciation driven by supply constraints. Eventually, that'll free some people from negative equity, and we'll get some sellers off the fence. They'll put their homes in the market. We'll see a cooling of home value appreciation, and then that cycle will repeat, we think. And in closing, I'll just say that we do think that I think what Jason asked us to kind of address in general was, do we think that this housing rebound is for real? And we think it is for real. We think that, as I mentioned, home values are already up 1.7% from where they were last year. We expect modest appreciation next year. Generally, we do expect 1 to 3% annualized appreciation over the near term. And it'll be more like 2016 before we'll get back to robust home value appreciation, or I shouldn't say robust, more normal appreciation, which is more in the 2.5 to 5% annualized range. So with that, I think I'll turn it over to Paul.
That's me. There you go. Okay, so I'd like to thank Doug and Jason for inviting me here this morning to talk about the housing recovery. So let me start by saying that, and this is important, I'm speaking today as a researcher and as a concerned citizen, and not as a representative of the Boston Fed or the Federal Reserve System. You recognize him. When I say we, I don't mean Ben and me. So what I'm going to talk about today, and I mean that, so don't say Fed official says, say Paul says. What I'm going to talk about today is a little more big picture than what Stan did. I'm going to really talk about understanding the role of foreclosures in this housing recovery. And in a sense, I'm going to argue why it is I don't think that the conventional wisdom is right. And the conventional wisdom about foreclosures and house prices is that lots of foreclosures are coming on the market in the next few years, and they're going to drive down prices. And the kind of the idea is, the narrative is, until we can clear out all these foreclosures, we can't have a housing recovery. And the evidence that people point to, first of all, there's a kind of theoretical argument, which is that it's just supply and demand. Foreclosures lead to supply, which leads to falling prices, and people say, well, that's just Econ 101. And then the second thing is people point to various things in the data that support this story. So what I'm going to argue this morning is that actually theory, economic theory, gives us very little guidance here. It's not just supply and demand. And then the data actually provides little support for the idea that it's necessary to get rid of all the foreclosures to clear out the negative equity problem before the housing market can recover. So what is my forecast? My forecast is, the good news here is that the large stock of distressed or potentially distressed property does not imply that we can't have a housing recovery. I don't think there's anything saying right now that housing couldn't take off. What's the bad news? The bad news is that economists suck at forecasting house prices. And so you should take everything I say with that in mind. Okay, so it's not just house prices. We actually suck at all asset prices. But okay, so let me talk about supply and demand. And this is going to seem kind of like I'm teaching a class. But it's important. So we have in the housing market, we have two markets. You have a rental market, and there's supply and demand in the rental market. And there's this thing called rent that brings supply and demand into line. And then you have a purchase market where you also have supply and demand. And in the purchase market, it's the house price that brings supply and demand into line. And so what happens? Well, for example, price and rent should be closely related. So if the price is too high, what happens? Well, supply flows from rental into the purchase market, and demand should flow from the purchase market into the rental market. If prices are high, then you're going to buy rather than you're going to rent rather than buy if you're a buyer, and if you're a seller, you're going to try and sell for a high price in the purchase market. And so what happens? Well, that brings these two things into line. It pushes down prices and pushes up rents to keep prices and rents in line. Why is this important? Well, what is the story with foreclosures? The story with foreclosures is, what the conventional wisdom is, that what's happening right now is when foreclosures come on the market, they increased supply, which lowers the price. But the key thing you have to remember about housing markets is it's not everybody needs a place to live. And all of these homeowners have to go somewhere. So one place they could go is they can go and buy another house. And it's not as difficult as you think, especially now. We have the foreclosures from a while ago. Whatever rules, if you lost your home to foreclosure in 2007, by now it's not that difficult to buy a house. And the rules are not nearly as draconian as people think about post-foreclosure buying another house. But even if you don't, what happens is you switch into the rental market, and that increases demand in the rental market, which drives up rents, which in turn drives up prices. The point I'm making here is that in the sort of Econ 101 classical supply and demand world, it is not the case that foreclosures unambiguously reduce prices. In the classical Econ 101 world that we think about, in fact, the effect of foreclosures on prices is ambiguous. And why is this important? It's if you say in the standard supply and demand framework, we can't appeal to the standard supply and demand framework. I'll come back to that. Can one build a model? Can economists come up with stories in which foreclosures affect house prices? Sure. Maybe the borrowers who lose their home move into caves. Maybe they move in with their parents, et cetera, et cetera. But then it's not simply supply and demand anymore. It's a much more complicated thing. And once you get into complicated models, trust me, economists can come up with anything. One can easily build a model in which foreclosures actually raise house prices. So what is the point here? The point is that this supply and demand model has never been a useful tool for understanding house prices. So this is the price to rent ratio going back to 1987. You can calculate these any way you want. But there's some idea that these things should stay within some bounds. And there's things, taxes, interest rates, all kinds of things that should move them around. But what happened? Well, starting in the early 2000s, this number began to go up and up and up. And the standard story was, well, something should be pushing this down. And there were economists all along here who said, oh, house prices are too high. The price to rent ratio is out of whack. Prices have to come down. And by this point, they were working at Starbucks. Because prices just kept going up. No matter how many times you said they were coming down, they kept going up faster until, of course, they stopped, and then they came down. And so what does this tell you? What it tells you is something else is at the heart of this price-to-rent ratio. And the problem is, and this is the problem with all asset prices, it has to do with people's beliefs about future house price appreciation. This was a period in which people had very optimistic beliefs about what was going to happen to house prices, and that is going to drive up the price-to-rent ratio. And so right now, what's happened is just the opposite. We have people who are very pessimistic about house prices, and there's not a lot you can do about that. So you can lower the interest rate, but at the end of the day, if you believe house prices are going to fall 2 or 3% a year, it doesn't matter how much we lower the interest rate. Okay, so let's go to the data now. And what the data, so one of the things that people often point to is this story that foreclosures cause damage to nearby properties, and that's the damage they cause. Okay, I have a new paper when we looked at this effect of distressed property on the sale prices of nearby properties. And we considered a sample of 158,000 repeat sales across 15 MSAs. And what we had that previous research didn't is we didn't just have foreclosures, we also could see before the foreclosure if the borrower was seriously delinquent. And what we found was that if there's a serious delinquency within 1/10 of a mile of a sale, the house price of the property that's selling is 1.2% lower. If there's a REO property, it's 0.9%. If there's a property that was formerly an REO, it's 0.6 within a year of the sale. And then if you look later, there's essentially no statistically meaningful effect of having a formerly distressed property in your area. What is the bottom line here? So the bad news is that foreclosure damage, to the extent it has an effect on the prices of neighboring properties, that has nothing to do with the foreclosure itself. It starts when the borrower becomes seriously delinquent. So what is the good news here? The good news is the effect is quite small. This is not something, 1% is not something that the typical homeowner is going to notice. Now, just to be clear here, this is not, the fact that these numbers are small, that's not just us. Everyone who has done this seriously has come up with very, very small numbers. Okay. Another thing that is misconception is that that the foreclosures have created this flood, they have had an effect on house prices because there's been this flood of property on the market. And so one thing you can look at, this is from the National Association of Realtors, it's smooth, but it's the inventory of homes for sale. And if you look at this, you see, well, look, there was this big boom in inventory here. Isn't that the foreclosures driving down house prices? But if you go and you look and you say, well, what was happening in that period? Actually, new listings are collapsing in this period. In fact, new listings, which includes foreclosures listed for sale, are at historic lows throughout this crisis period, throughout basically since, it was collapsing since basically the peak of the boom. It's collapsed, and we've had extremely low levels of listings. This includes the foreclosures. And so you ask, how can inventory be so high when listings are so low? And the answer is because listings are the properties going into the inventory of properties for sale. And the problem is that the properties going out of the pool of properties for sale, which are the sales, that number fell faster. And so basically, why is inventory falling now? It's because sales are outpacing listings. And that, until that happened, which was basically here sometime in 2008, basically we had this inventory growing. But the key point here is we haven't had some flood of property on the market. The number of properties coming on the market throughout the last 5 years has been exceptionally low. Okay, another question is, can a market recover with an ongoing foreclosure problem? So we had data for this in Massachusetts from the early 90s, and the foreclosure problem in Massachusetts was bad, and it was bad. It started really in 1991. It peaked in 1992, but it was still elevated all the way through 1996. So this is 2,000. These are foreclosures by quarter. There's 2,000, 1,500. These are huge numbers for Massachusetts. And yet, house prices started rising, basically bottomed out here in 1991, and they were rising steadily throughout this period. And in a sense, what's happening here is house prices are rising. That's pushing down foreclosures, not the other way. Okay, the last thing is there's the stock of new homes. So you have to remember, this is the worst housing new construction bust in American history. So we basically stopped building new homes in 2007. If you look at this, right, new housing starts, it's lower. Basically, for the last 5 years, it's been lower than it was at any point in my lifetime, which is not that long. Okay, so let me just conclude. Let me talk about forecasting. I said economists suck at forecasting house price. Economic theory says that price variation, in some sense, to a first approximation, is unforecastable. This is one rare instance where economic theory is borne out in the data. It says you shouldn't be able to forecast it, and we can't, and that's true for economists. It's true for practitioners. The consensus did not anticipate the boom in the late 1990s. It did not anticipate the bust in 2006. In 2006, some argued that financial innovation had permanently changed the relationship between house prices and rents. It was a different use of the word permanent from the one you're familiar with. If simple supply and demand models were really useful, we wouldn't be in this mess today. The reason we're in this mess is because these models are not useful for figuring out house prices. 6 months ago, actually it wasn't 6 months ago, it was in January, I was at the American Securitization Forum in Las Vegas, and I wrote on my slide, good news, economists are predicting falling house prices, so it's time to buy, and that was good advice. Okay, so let me just conclude with 2 slides about forecasting house prices. This is a cover of Boston Magazine. It said, the smart real estate moves to make right now, buy, buy, buy. The date is May of 2006. And this is a slide, this is compiled from a bunch of something JP Morgan put out called HPA Update. This was in 2006 and 2007. And so house prices, as we all know now, they were already falling basically the beginning of 2006. But by the end of 2006, the JP Morgan reports are basically calling a bottom. Early stabilization signs, stronger stabilization signs. This is well into 2007, so this is based on July of 2007 data. So the crisis is already started, right? And they say we're near bottom on HPA. Then at some point, there was a huge paradigm shift, and they went to saying, oh no, house prices are going to fall 30%. There was 15% in May of 2008, but then they got even worse, and in fact, they overshot in the other direction. So what is the point here? The point is not to listen to economists. And that's what you can learn from me. Okay. So.
We're going to open it up to questions if anybody has any for Paul and Stan right now. Mr. Pollack? Please state your name and organization also.
Alex Pollack of American Enterprise Institute. Thanks for the great presentations. We couldn't see the slides that well, at least I couldn't from the back row here. Could I ask on the Zillow slide, what was your long-term trend, price appreciation that you had on one of those slides had a long-term trend on it, and what was your average annual long-term price trend number?
I think, was that from the expectation from the...
yeah, it's where you were comparing it to the economists' expectations.
Right, exactly, yeah. So that was the period from, I believe, 1987 through 1999, and it was the long-term trend was roughly about 3 to 3.25% a year over that period of time, yeah.
That's sort of the high side of your near-term expectation.
Well, that was the trend over that period of time. In the economist panel, the long-term trend, the median trend is below that right now, so it's below what we were seeing over that period of time. And our own expectations, which we'll take with a grain of salt given Paul's recent recitation to us, was even more muted than that, 1 to 3% over the next 2 to 4 years. So really, and then if you look actually over a period of time from, if you take Bob Shiller's reconstruction of the home value trend from 1890 through 2012, you end up with basically a trend which is a long-term return to housing as an asset class of between 2.5% to 5% a year. We think we'll be below that, though, for the next few years.
Hey, I'd like to ask a question. I just recently wrote a piece where I just cautioned against some of the fundamentals that were increasing. And forgive me if you went over this, but can you guys speak to some of the Stan? I heard you questioning markets like Phoenix, where you thought the fundamentals that were supporting the price increases were not sustainable. Can you talk about some of the other markets and caution against some of the things you see that are not sustainable in those rising metro markets?
Yeah, and when I say it's not sustainable, I guess I just mean in terms of typically home values as an asset class is going to track inflation or growth in incomes. And people think of it at various times. They get diluted into thinking it's as an asset class, it's a great investment vehicle, and it's going to outperform incomes or inflation. And over the long term, it generally tracks those two. So in terms of fundamentals, I mean home prices in Phoenix relative to those things, growth in incomes, or home prices can increase if half of America wanted to move to Phoenix, then home prices would increase because we'd have a lot more demand there. But neither of those two things have happened. We haven't seen a radical increase in income, median household income in Phoenix, nor have we seen a significant uptick in migration into that market. So that's what I mean by the fundamentals. Now, another way to think about fundamentals is supply and demand. And clearly, on the purchase side, demand is exceeding supply, which is bidding up those prices. We do tend to think, though, that markets like Phoenix, Miami, a few of the hard-hit markets have a confluence of factors that make them quite unique, and we shouldn't generalize too much for other hard-hit markets in terms of what we're going to see. Those factors include, I already mentioned negative equity, extraordinary high rates of negative equity, which we think are trapping homeowners in their homes. You already have the natural condition that at the market bottom, sellers tend not to want to come out and sell their homes. Anyone in Phoenix who's been able to hang on for 5-6 years in the housing downturn hasn't been hanging on with their teeth, by their fingernails, just to sell at the precise bottom of the market in Phoenix. So that's another reason why supply gets constrained at the bottom is sellers don't want to sell. It's natural market psychology. Every buyer wants to buy, but no seller wants to sell at the bottom. And then Phoenix on the demand side has some pretty unique characteristics. Phoenix and Miami both. A lot of international buyers, Canadians in Phoenix, South Americans and Europeans in Miami, combined with very substantial investor portions of those markets, where anywhere from 30 to 50% of those two markets are investors buying up homes to convert them into rentals. And then the usual mainstream buyers getting off the fence, which all markets are seeing. You're seeing that in Phoenix and Miami as well. But I think in those two markets and a few others, I would say that they have some unique demand and supply side characteristics that are not exactly generalizable. I mean, you can look at Vegas just right north of Phoenix, and you're seeing a different dynamic there. I think largely because Vegas does not quite have the international buyer presence that Miami and Phoenix do, as well as the economy is a little bit different than Phoenix. Phoenix is more of a broad-based economy. Vegas being more dependent on tourism, I think has led the dynamics to be different in Vegas. We're not seeing quite that V-shaped recovery in Vegas.
Paul?
Well, I mean, I would say, again, you have to be very careful trying to make sense of house prices, and especially in Phoenix and Las Vegas. So we know what happened in those cities over the last few years. So the idea that house prices, I mean, for the supply and demand story really to make sense right now, we would have to assume that somehow we'd gotten back to the right place, and then the only things left to drive house prices are these supply and demand factors. But I have no idea whether house prices are too low or too high to begin with in Phoenix and Las Vegas or anywhere for that matter. And so it's hard to know whether what's happening is that there's some some fundamental factors that are actually driving house prices up right now because they're quote unquote too low, or whether the house price is pushing them up from some correct level. But I should also caution you about asset prices. I mean, we have to be very, very careful with the use of the word sustainable. Sustainable doesn't appear in asset pricing textbooks. It's not a word that so is our house prices sustainable? In some sense, the kind of basic economics would tell you all asset prices are sustainable. That's why they are where they are. And I'm not saying they are. Obviously, the model doesn't work. The model is terrible, and it's why we're in this mess right now. But that means you can't go around and use the model to forecast house prices. So that's the problem we have, is that we have a model that basically isn't that useful, and that's why we get these bizarre gyrations in house prices.
Sir.
Jack Welch with Treasury. I'm wondering if either of you have looked at the recent trends of inventory shifting from home ownership to rental in terms of the types of programs that Freddie and Fannie have recently announced where they're selling inventory and requiring investors to turn those homes into rental properties for a period of time, and investors coming into the market, buying up foreclosed properties and REOs in bulk and moving those in the rental market, and what that might be doing to the housing price and whether or not this is a trend that's having any impact at all.
I guess I can speak to just generally the conversion of housing stock from the purchase market, owner-occupied side to the rental side, which is a pretty aggressive, a pretty powerful dynamic in most of these markets. In terms of your specific question about programs by Fannie and Freddie to make that, I mean, generally that's been a private sector play that has not needed the impetus of the federal government to make that happen. And in fact, it's probably good that the federal government not get involved there, because the private sector, the market is working naturally. That basically all these people who are being foreclosed on need to live somewhere, as Paul said. And so we're seeing shortages of rental supply, which is bidding up prices, which then the market reacts naturally. People say, well, I'll go buy up one of these cheap for sale homes that was formerly owner-occupied, converted into rental. And that's not a, I mean, we are seeing now larger institutions starting to do that, but typically that's been a very long tail of mom and pop buyers who are making that happen. And it's one of the nice parts of a market economy is that no one told them to go do that. It just happens, and it's what needed to happen.
One of my colleagues actually painstakingly, it's very difficult to identify non-occupant owners in the data. I mean, they don't identify themselves as such typically. But she went through and very, very carefully hand-coded the REO sales in Boston. And about half of them were to investors, and this has been typical throughout the crisis. So I think the market is basically doing that. You know, and you'll see, you know, this is public records data, so you can see the name of the person, and then you can see the listing of the property on Craigslist. So this is going on, I think, in a quite vigorous way. So I don't know that I don't know, as Stan said, I don't know. I think this is something the market can do just fine.
It is interesting that when you look at some markets like Vegas and Miami, if you look at we do track we don't track explicitly the investor, the percentage of the market that's investor-led. Of course, the NAR practitioner survey would track that. We do track cash buyers and FHA buyers, and you know, it is extraordinary the extent to which some of these markets like Phoenix and Miami, you know, at least probably as much recently as a year ago, were really bifurcated markets where it was either you were paying all cash, and most of that was probably investors or international buyers, or you were getting an FHA mortgage. There was very little middle ground. That's not to say there's no middle ground, but a lot of it was either FHA or cash buyers. Very bifurcated market. So kind of a dumbbell with not a lot of conventional buyers putting 20% down in between.
Okay. Thank you. Thank you guys very much. Okay, for our next panel, we're going to delve into why it's urgent that the next Congress jump into housing and address GSE reform. And for that, I'd like to call up our moderator. Where's Margaret? Margaret Chadbourne from Reuters.
All right, good morning. I wanted to introduce the panel that was going to be speaking with me today about GSE reform. We're going to have Douglas Holtz-Eakin, president of the American Action Forum and the former director of the Congressional Budget Office. And then we have Susan Wachter, professor of real estate and finance at Wharton, the University of Pennsylvania. Gary Thomas, president-elect of the National Association of Realtors. And Chris Mayer, professor of real estate at Columbia University. All right, just to make sure my mic is working here. Everyone can hear me? Okay. Thank you all for being here. And I just wanted to start off the discussion. We've heard a lot today that housing is starting to recover. You know, Secretary Donovan did mention that some headwinds do exist. But is the improvement, the uptick in the housing market, reason alone for the government, for Congress to start talking about loosening a government backstop in the housing finance system? Anyone want to start off?
So I'll jump in. Yeah, I think there's a clear and obvious need for reform of the GSEs, the Fannie Freddie structure we had for so many years. But I don't think Congress is going to be aggressive about doing that as long as it's such a large fraction of the mortgage market. And so I think the real hope of a housing upturn will in fact be a greater entry of private capital and a little more comfort on Capitol Hill. If they do reform and they make some mistakes, they don't crater the housing market.
I agree. We do need more private capital in the market. But the private capital is itself fearful of coming into the market. So I don't totally agree that it's just a question of the government withdrawing. If it were, that we'd see more private capital securitization going on in the jumbo market. You know, we had $700 billion worth of securitization. That's down to $1 billion. And that's not the case with CMBS. CMBS is self-organized, has come back. It hasn't come back in RMBS, and I believe that's because there's fear about the rules of the road. We need rules of the road to make the redwood securities be able to get out there, get investors, come back even in the jumbo part of the market.
So it seems to be that this divisive question is how should the government preserve what they're doing now with the benefits that have been provided to borrowers? Would the rest of our panel like to step in? And you're shaking your head.
I'm not at all in that camp. You know, I certainly agree with, I think, Doug and Susan that, you know, the impetus for GSE reform should not be about how the market's functioning now, because it's functioning just horribly. the mortgage market. So, the Federal Reserve did QE3, announced it, and they actually did something that we've never seen before in the data, which is they actually drove the price of mortgage bonds essentially down to the Treasury rate, which was an enormous decline in wholesale funding rates. If you look at what happened to actual mortgage rates, absolutely nothing. 175 basis point spread between wholesale funding rates in the bond market, that's what investors are doing, and the actual credit getting to homeowners. So I think the mortgage market is functioning abysmally, and people are confusing what are record low rates with what is really poor availability of credit and spreads in the middle for lenders that are just absolutely crazy. And I think that is a result of policy. It's a result of the existing regulation of Fannie Mae and Freddie Mac and how they're operating. And I think that should be the impetus for reform, because the existing market is really functioning very, very badly at the moment. It isn't providing credit for marginal credits, and it's sort of pushing us into a rental market that I think, yes, in one sense the market should resolve, but the idea of sort of middle-income people being renters, we could sort of go into that another point. There are a whole host of reasons to think that isn't what a market outcome would be, and it doesn't make a lot of sense.
I mean,
Yeah. All right. NAR supports restructuring of the secondary mortgage market. We think we need to do that, but it needs to be a reliable source of lending for consumers in all types of markets. It can't just be at the time of a crisis, and it can't be when everything is rosy. Restructuring is necessary in a response to the failure of Fannie and Freddie, and we need to get on with it and get it restructured properly.
If I could just ask you to turn your mic on, Professor Wachter. Thank you.
There you go.
I guess I might recenter the debate at this point in terms of how Fannie and Freddie are operating. Right now, we've been operating in a system where they're in conservatorship. That was kind of seen as an emergency solution. Now we're existing in a long-term state of conservatorship. And their regulator keeps putting the onus on Congress to do something with their mandate and make a change. What do you think it's going to take? What's the political calculations, the timeline? What will it take to get Congress to act?
I mean, Congress didn't act in the face of what has been a record collapse of the housing market. I don't think what's going to drive this is about the economy. Maybe in the upcoming sessions we'll see a little bit more. But my suspicion is that housing, isn't going to be a part of that debate. It's all going to be about dealing with the budget crisis, et cetera. So it's the fiscal cliff. So it's really hard to imagine that this is going to get onto anybody's radar screen very quickly, unfortunately.
Actually, Congress did act. Congress increased the loan limits for FHA, which was a little bit ironic that FHA, which is fully government and taxpayer supported, comes to play as opposed to other options. And this was both sides of the political spectrum, recognizing that without Fannie, Freddie, FHA, we would potentially be in 2.0 Great Depression. So I actually think that there is more promising room for collaborative coming together, both sides of the spectrum, and that there are discussions going on right now, and my belief is that right after the election, there will be significant progress, and we will see on the table some proposals which both sides can come together on.
Anyone on this panel disagree with that calculation? Is it going to be fiscal?
I don't think it's going to happen that fast.
Yeah, no, I mean,
I really don't. I can't see it happening that fast. There's too many things that Congress is going to have to deal with right away, and that will be on the back burner, not to say that it won't have discussions.
That's all I mean, is that there will be discussions. I don't think we're going to have a vote in January 15th. No, but I think discussions of options, that there will be potential buy-in on both sides, will start.
Well, they've already started.
They have started. That's true.
There have been floated out many different proposals that got nowhere. So.
Well, but now there are behind the scenes. I mean, we're part of it right here.
Right.
How can Washington?
It's a good news, bad news story. I mean, I think it's true. There's been a lot of discussion behind the scenes. There's a recognition that Fannie and Freddie will not continue in their current form and cannot. The Treasury sealed that deal by imposing 100% profits tax on them, so that's not a great outlook. And that's all good news. I mean, we need the next generation. We do not want to have the current model, and people understand that. The bad news is, A, you cannot lose money betting on Congress doing nothing, and B, they have an enormous amount of things to do that come in front of this in line. There's just no doubt about it. So I would be shocked to see legislation move in 2013. I think it's just really optimistic to think that would happen.
Right.
I agree. I don't think we'll see legislation. And we need consensus building first.
Right.
The question is whether consensus building is possible, and I think it is possible.
Why has
So
the
I
status
would-
quo been
I would there is one legislative bill I'm sort of hopeful that we're going to see, which is Boxer-Menendez on refi. At least Democratic leadership has said they're going to try and bring it to the floor for a vote. That was one of the things that Secretary Donovan talked about in his remarks earlier. That might open up the opportunity for 10 to 14 million homeowners to refinance, and it would be a step along the way of, I think, reducing the cost of the guarantee and help us down a path where we can sort of start to phase out. So I'm sort of hopeful that we're going to see some housing legislation, but the big GSE reform, I'm with the panel on that being pretty far.
There might be some disagreement.
I'm here to violently disagree with Chris. That's my job. I think that'd be a horrific move from a number of perspectives. I mean, first thing is we have got to stop having housing programs. We've had like 14 housing programs, and it's time to just stop the bombing of the housing sector with legislation and let people figure out what the rules are. We also have too many other things going on. We've got QM, QRM, we've got the Basel III Accords being implemented, and the result is we're not getting credit into the mortgage market because there is, in fact, too much going on. So I think there should be a stand down until you're going to do something big and real like GSE reform.
We've seen almost no legislation in this area other than raising loan limits, and we've essentially let run an incredibly dysfunctional market. So the reason we need legislation and guidance is actually to rein in what has been, I think, really poor stewardship by FHFA, which has created the circumstance where we don't have private capital, where we don't have markets functioning. I think virtually every economist would tell you monetary policy is functioning terribly at getting into the housing market right now because of these frictions. And so the role of Boxer-Menendez and the role of what I think other legislation should be is to reduce the frictions to let the market work, because in a normally functioning market, you would see large numbers of refinancings and you would see the economy self-correcting. So it's exactly the lack of the functioning of the market what you would like congressional action to fix. And if we can't even fix the low-hanging fruit, it's going to be really, really hard to, we could be out to 2015 or longer before we really get anything done in this.
Yeah, but the problem is that we're doing a lot for refinancing, but we're not doing anything for financing of new purchases because it's so stymied right now with QRM and QM and all of the, all the things around that have stalled the market.
They're not mutually exclusive.
Except
No,
for
I know
FHA.
it.
They're not.
Except for FHA, that's right, but that's the only
And
thing.
that, of course, is the opposite of what everyone here
Right.
wants. Everyone says, bring in private capital. And so how are we going to do that in the long run? That's the question which we need to start having discussions, not only behind the scenes, but so that we can actually have consensus building in the public domain.
So at the end of the day, it seems like there's going to have to be discussion on risks versus protections for lenders and all those investors involved. How do you see the economy being challenged by finding the right balance?
Well, the economy's challenged by not finding the right balance because if you don't get an uplift in housing, then the economy is not going to grow as rapidly as it could. The housing industry has always brought the economy out of recessions except twice. And the two times it didn't were wars. And I don't think we want to go into that again.
Right. Well, we've tried that. It hasn't
didn't
worked.
So I think there have always been these two camps on the recovery. One is you've got to fix housing in order to get an economic recovery, and then the other camp is, well, if we can just get better economic growth, that's going to spill over into the housing market, raise demand, fix prices. And I am schizophrenic, and I have migrated firmly from fixed housing to get an economic recovery into the latter camp, because I just think the capacity of the government to come up with fixes has just been proven to be just too limited. And I think we'll get better economic growth, and we'll work through some of the problems that are out there, largely with the private sector. And then we'll figure out what the next generation looks like. And so I think that's the key to economic recovery.
The good news here is that we don't have to choose one or the other of your hands
both
or
going
our
on, as it
hands.
turns out.
Because
Yep.
actually what's happening is housing is now contributing to the overall recovery, albeit it's not a strong recovery. The recovery is also contributing to housing. So I think that what we heard from Willow before is absolutely right on. There's consensus. There's not a wide, disparate. By the way, there was consensus even going into the crisis, and at the top of the crisis, that prices were way out of line. So economists are not all over the place. Sometimes, of course, we do have bubbles, and economists were calling that bubble. I was, others. So right now, it looks as though the market is recovering. The housing market's recovering. And so, of course, is the rental market even more so, and the overall economy. And they're a reinforcing positive cycle. Instead of a vicious cycle, we now have a virtuous cycle, slow but nonetheless real. But the problem is it's reliant on government financing, one way or the other. And that is a future barrier, which it's not a fiscal cliff. The fiscal cliff in the housing finance sector was removed by the Treasury action a few months ago. So it's, in some ways, that took us all the feet off the burner. So that's good. But bad news is we must have this discussion. And we are ideologically all over the place on this. And it's not a matter of ideology. We actually have to understand how the housing finance market works, so that we can recreate the market.
I guess one thing I would be careful of is getting all excited about whether it's 1%, 2%, 4%, or 5% to pick the highest number off of Stan's pictures of what the economists are forecasting. Right? We've seen anywhere from a 20 to 60% decline in home prices, and the increases are off a smaller base than the decreases were, so they don't add. We're at a horribly low level of functioning of the housing market. By the numbers Stan put up, huge numbers of Americans are underwater on their homes and are going to be underwater for a very long time. In the economy, the data that we looked at on housing starts, bouncing around 500,000 to 700,000 housing starts a year is just an abysmal number. And what we're looking at to sort of fix this is private capital of people coming in and buying homes and charging rents that are 12 to 14% of the price of a home. And you're sort of telling low to middle income people that what you're going to do is pay 12 to 14% of the value of the home in rent. Whereas if we could sort of help it get a functioning mortgage market, they would be buying and paying mortgage rates that are much lower than that. And that market is just a crazy market because you have sort of people making improvements on the homes that you pick up a phone and call that a homeowner used to do themselves. And that shows up in rent. And so the whole issue of how you maintain a home, how you sort of think about it, the stability of communities, rental isn't this great panacea that we should all look at bringing private capital into rent. Rental is the result of an inability of credit to get through the cycle and through to people who should be, we should be thinking about helping to save and buy homes. And so I mean, it is a market outcome in a sense, but it's a market outcome of an incredibly dysfunctional mortgage system, and it's not something we should aspire to. It's not something we should call a market outcome of anything. It is a result of policies that have left the mortgage market with something that private capital doesn't want to come into. And I don't think we should be celebrating this stuff.
You said this is a dysfunctional market we're seeing. Why has the status quo then been good for everyone? What's the biggest threat to addressing housing finance at this point, and why has the status quo been so appetizing to stakeholders?
It's politics, right? I mean, why haven't we done anything on a whole host of other things? The politics of the situation seem to make it impossible, and so we have, regulation going on not by anybody who was either elected or really even appointed or thought about as being, managing the housing finance system. And then you have the FHA on the other side, which faces big problems associated with their legacy book, not their new lending, that has put the FHA in a lot of trouble. And we can't get any legislation out of Congress to get direction, and then we have rules to be implemented through Dodd-Frank that are leaving complete uncertainty to the industry. So I think these are political challenges.
And I have a pet theory that one way to sort of get this going a little bit more quickly is, in fact, to break it into two different problems, and one of which is to put aside the sort of single-family home that everyone thinks about as the entire market, and actually work on multifamily reform for GSEs, because I think it'd be easier to get to consensus. You wouldn't have to fight about the nature of the 30-year fixed-rate mortgage and its future. You could sort of do things that I believe are far more bipartisan and would actually give us a stepping stone into a much more healthy both market, but also the politics of doing housing reform.
I actually agree with that. I think that we're close, where we might be close to a consensus on multifamily solutions. And that consensus could then be a template for single family as well. Ironically, the conversations that I've been part of, hoping not to reveal anything, but too much, is that on the multifamily side, there seems to be some broad support for on the multifamily side, for catastrophic government role. Do you see that as well?
Yeah.
Yeah, covered bonds looks like it would be a good way to go on the multifamily side.
Well, covered bonds, I wouldn't go and say that covered bonds part of the multifamily or the only part of the multifamily will be a template for a single family. Unfortunately, they can't.
No,
as you well know.
exactly.
Right.
But I think you will see that on the multifamily side.
But there are other solutions on the multifamily side which I think are very good potential templates for the single family.
The multifamily market, though, has worked pretty well. I mean,
That's the other reason to work on it. I mean,
right. And, I mean, we're providing reasonable credit, and a lot of the growth in construction that we are seeing is predominantly multifamily, not single.
That's because of demand.
But it's Fannie Freddie supported and FHA supported. So on the one hand, it's worked very well, but on the other hand, it too is supported by these public entities, which are taxpayer ultimately supported.
Right. But there's actually, I mean, we would see almost as much going on the multifamily side because REITs can raise money in the capital markets at just about the same cost.
Well, that's
as
speculation.
GSE debt.
Maybe so, maybe not. CMBS has come back, but CMBS in the non-multifamily has come back to much, much smaller degree. I think most people, and that is part of the discussion, are not ready to say, or maybe others are. It'd be interesting to hear what people around the panel agree with Chris, that we could simply take out government guarantee or any role of government in multifamily, which is basically, I hear what you're saying.
I mean, I think the role of government in multifamily has not been as strong a role on one side or the other because there's incremental financing that has at many times been in similar cost. The place it helped was in 2009 to 2011 when the credit markets were functioning badly.
Exactly.
And that's kind of when I think a lot of people would decide that a government backstop makes sense, is when credit is really, really challenging to get. You want the government to step in and not let the bottom fall out on credit.
But I think the generic argument on both sides, actually, for the reason you want to think about how to construct a sensible catastrophic backstop is that Congress will step in a crisis. I mean, we know that. So we might as well acknowledge that there will be a backstop, and it's either Congress in the moment making something up or something we thought about in advance, priced appropriately, and works for the market. So I think that's got to be, to me, that's got to be the framework.
Standing up something in the middle of a crisis is never worked, and so having is, and absolutely, we will have intervention, but not necessarily in a good way.
Yeah, but the part of the problem is there, if we got together a group of economists or a group of sort of economist/policy folks that we have on, sitting around on this panel, right, we could come up with, from left, right, and center, a fairly good set of views about how to structure a program that would be, playing off of the white paper, some kind of backstop, and the details of it, there would be a fairly broad consensus. But when it enters the political debate, that's not at all the conversation one hears. You hear what I think are really outrageous claims about, what caused the crisis, and claims about Fannie and Freddie were the whole thing. We have to completely eliminate them. You get the sort of political rhetoric that's around it that isn't fact-based, that is more rhetorical. We end up with a whole different set of problems, which make it very, very hard to get a consensus among sort of people who study the issue and have that show up in the political system.
You mentioned the white paper that the Treasury released in 2011, and there hasn't been full force going towards one of the three options that they laid on the table for Congress. What's the reasoning behind that, and do you think that what was laid out gave anything of merit and that will move forward on such a proposal when housing reform does come about?
You want?
Well, look, I thought the paper was a very reasonable but high-level sketch of the options, and legislation requires a lot more detail. This is, as with all big reforms, and this is going to be a big and important reform, it's going to have to be bipartisan in nature, or it's not going to be durable. And to get those kinds of reforms requires White House leadership. And there's just no way around that. And the question is, at what point in the next administration will the White House be able to turn its attention to this particular problem? Given the long list of challenges we face, I don't think that'll be quickly. But in the interim, you can do the kind of consensus building behind the scenes when the political rhetoric hits, as it ultimately always will, and I think that's just part of life. Maybe I'm just been in town too long. You just acknowledge those outliers, and you sort of have to build the center, and that only the White House can really make that stick.
I do think that there are things FHFA can do in the process, some of which are in their strategic plan, which I think are about putting the infrastructure in place for a broad set of things. And I think one of the things that they've done well is it laid out a set of ideas that are going to sort of lead to, that are consistent with bringing in sort of capital. I frankly wish they were pushing that forward much more quickly and were sort of more aggressive about things that would affect credit today, as opposed to sort of a longer run infrastructure. So I'd love to see things about reps and warrant. I mean, there's just lots of stuff that are not going to make headlines, that are little things, but when the compliance people all get together, it just turns out to be a big challenge.
I agree with you, Chris, on this. I think that one of the things that's going to force movement is that FHFA is moving, and that it has a strategic plan, and the strategic plan does involve bringing in private capital. And I think that there's a question at that point when the date that hits the market, okay, where is the administration on this? Where is Congress on this? And I think it will force a dialogue.
But the bringing in private capital that FHFA, this is actually, it's the one part of the plan I don't like that they're sort of doing, which is they're sort of selling risk pieces out into the market, but they're not allowing people to control the risk. And just selling off portions of the government risk in the outside without the idea of private capital controlling the risk, to me, is kind of moving in the wrong direction. It's certainly the direction away from some of the lessons we've learned from the crisis, which is the big part of having private sectors deal with risk is for them to be able to manage it. And so if you're not controlling the origination, if you're not controlling the underwriting, if you're not controlling the servicing, but you're buying the risk, you haven't really done anything about the underlying risk, you're just allocating it out. It's fine to move a little bit of it off the taxpayers at some price, but the real goal of a well-functioning mortgage finance system is that the people who hold the risk control the risk. And that's what aligns incentives. And so the idea that we're just going to sell off pieces of the risk without giving it's the wrong way of bringing private capital in. We want private capital to come in and mitigate the risk. And so if they make a bad loan, that they bear the consequences. Right now, you could have bad loans being made for other reasons, and people will just price that in the future.
You mentioned leadership needs to come from the White House. Right now, we're involved in a campaign heading towards the November 6 presidential elections, and President Obama and his opponent, Mitt Romney, really have not discussed housing to a large degree. What is the most important thing policymakers can do right now? And that would include doing nothing. And which presidency, an Obama presidency or Romney presidency, would have the most impact on propelling housing finance reform?
So be brave. So economists forecast poorly. We've heard that. Political scientists forecast worse. So let's go into political science. No, I think honestly, I'm in the camp that says we got enough going on. Don't do more right now. I mean, we really do have an enormous amount on the regulatory front, in particular, that's hitting the housing finance world. And it isn't going to matter who the next president is. I mean, as it turns out. But you just said
it needs to come from the White House.
I know, but the point is, whoever is the next president is going to do things not because they want to, because they have to. And there's a whole list of things that have to get done, and that includes the fiscal outlook, and it's going to include what do you do with Fannie and Freddie and the FHA, right? The FHA is bleeding money right now. Fannie and Freddie are wards of the state in an unsustainable fashion, and so it isn't going to matter who the president is. This is going to have to be dealt with, and the question is, will there be enough spade work done in advance so that there's a consensus on Capitol Hill that they can drive? That's the issue.
Right, so that I hate to say I disagree with you
never happened, Chris.
on this, but I think I think it probably does matter. We're going to see very different policies from the two, even though neither camp has been very clear about what they're about the specifics of what they're going to be doing. I think it's very clear that they would go in quite different directions.
I don't disagree about that. I just think they will both have to deal with it.
Right, but I'm also not convinced on the. I think the appointments that will be made will be sort of things like running the FHFA, sorry, and running the FHA. But I don't think the have to deal with it is going to really happen. So as long as the consensus forecast that Stan gave is right, and with all Paul's caveats that we should take very seriously, but those things said, FHA will squeak through if house prices are sort of rising, partly because they're funding the bad legacy loans with very profitable existing loans, and so the fund will probably squeak through if house prices don't go down again, subject to Paul's important caveat. So I think they're not going to be forced to do anything there. And frankly, I don't see what forces dealing with the GSEs. They have a massive deficit. They can continue to earn profits and pay taxpayers back. By not dealing with it, that's sort of an easy source of revenue for Congress to point to when they've got other issues. I'm just not sure what the catalyst is to actually force anything. I think Lori Goodman makes a compelling argument in this, that it's going to be pretty easy to kick the can down the road in the current political environment and not do a lot, and then it's going to be really a matter of who runs FHA and what their policies are and who runs FHFA, because FHFA becomes the place that sets de facto policy without congressional guidance. And so I think it's going to be in those little things, but I wish we wouldn't kick the can down the road on all this stuff.
But that's exactly right. It is FHFA that will set up the rules, and then there will need to be a response. So I do think we do have a catalyst.
We could. I agree. Yep.
I think we're going to open up questions from the audience at this time.
One of the items on the roadmap of the Treasury white paper that we've all referenced that you referenced in the panel was for the future of mortgage finance reform. One of the steps on that roadmap was lowering the loan limits for Fannie, Freddie, and FHA. And of course, there was an attempt to do that last November, only partially successful. So we kept the loan limits high on the FHA loan limits. I'm curious about each of your thoughts about lowering the loan limits, whether it's a reasonable step to take, why it didn't happen, and prospects for it going forward.
I think it's utterly symptomatic of how scared Congress is to do anything serious in housing, because even that, many people thought would somehow crater the housing market, and they are terrified of the sort of unintended consequences of any serious reform. I think that's a reality of where we are, and it's one of the reasons that I think, waiting, hopefully having the economy strengthen and pull housing along with it, and we're getting some real response in starts and things now across the country. More than half the sort of metropolitan housing markets are showing some real progress in that front. So I think that that didn't happen because they were terrified, and with time and a little better performance, they'll be less terrified, and we'll actually get something done. But
terror is not completely the wrong response, actually. Certainly in the past, and if they dramatically lowered them across the board, including for FHA, there would be a negative impact on the housing market, which could be substantial. And since expectations, as Paul well put out there, do drive the market, and housing finance is, for almost all buyers, critical, we could crater this market. It's possible. Congress could do it. So inaction, in some cases, might be a lot better than action. Now, on the other hand, everyone agrees, there's consensus, that we must pull back this 90% federalization of the housing market. This is not consistent with a capitalist private sector world where most of our economy is, and everyone would agree, ideally, there should be private capital at risk. But if you do that, if you pull back without there are rules of the game for the private sector to get comfortable, to get back in, reassurance that, in fact, they can invest for the long run, and remember, there is a long run in a housing finance market. That's where the risk comes. It's not an accident that we don't have Redwood out there coming out with, instead of $1 billion, which is 1/700th of what the market was, why aren't they out there with $5 billion, $10 billion, $20 billion, $30 billion, as they are in the CMBS market? Because the rules are not yet there. For the private sector, they're not yet there.
I think the pullout of there are two questions. One of them is how the government comes out of the sort of guarantee which the white paper was talking about, and the second should be when that happens. And I think the first step should be, as I think Susan and all of us sort of talked about, is the idea of just establishing a set of ground rules that private capital will come in, setting up a reasonable set of rules for QM and QRM, which should hopefully happen before the end of the year, and set up a basic set of ground rules for how this thing is functioning, some of which would follow the FHFA strategic plan as well. Once you do that and you actually see private capital coming in, at that point you want to start pulling out. I do think FHFA is, while not raising the loan limits, they are actually raising the guarantee fee, which has the same effect of pulling back government support. And it's kind of odd that essentially you have the Fed pushing down rates and FHFA taking the money into the GSEs through. It's an odd kind of circular thing with the government because the premiums are going there.
Being, Chris, so very low, the increase in the G fee is minimal in terms of overall impact. It can't really be nothing like raising.
Every one of these things is minimal until the total spread isn't minimal.
Well, I'm not saying that you couldn't raise the G fee to a point where it would really be a serious problem, but when we have mortgage rates at 3.5%, as you well have said, it's not the mortgage rates and the G fee plus the mortgage rates that is keeping this market from flourishing.
Any other questions?
Thanks. Fred Miller, Warehouser. What's your thought on Treasury Secretary Geithner single-handedly trying to reform the GSEs? I mean, he tinkered with the way that the repayment plan would signal an eventual wind down. How do you see Congress reacting to that in 2013, and how does private capital react to that?
Have I missed something? Has he done something? Or are you just saying if you were him, you would do something?
And they did change the nature of the preferred
stock.
You're
talking about the
repayment.
Okay. Yeah. Well, that's basically takes
and
off.
dividend repayment.
And is that what you're referring to?
Yeah.
Okay. I'm sorry. Well, I think that was important. I think we had a minor fiscal cliff there, which with a major fiscal cliff out there, we might have come actually to the minor and fallen off. So I think that he needed to do that. But it does kick the can down the road.
So, go ahead.
It probably takes the emphasis off of it a little bit. So it allows them to step back and watch and see how that works. Again, I don't think they're going to do anything rapidly. And so this just gives them a little bit more time to stall.
I mean, it's just,
Right, exactly.
I have very mixed emotions about this whole thing because the truth is, I mean, Fannie and Freddie are now instruments of government policy. They're agencies of the government, and they should be on the books. And the CBO put them on the books, and if they're on the books as they should be, this is just an intergovernmental transfer, and it doesn't matter a bit how they structure it. So, that's how it should be. And we have these large agencies of the federal government that are not functioning well, and we need big governmental reform. It's not happening fast, and I don't think the secretary has driven that very, very hard or very far at this point.
Yeah, Joe Ventron with the Realtors. Could you comment on the recent FHFA 5-state variable G fee edict that came out and the impact that would have on the future of why we even have a national secondary mortgage market?
Go ahead.
I think it's a well-justified move on their part. They're states have hugely different, to kind of clarify what this was, what FHFA did was put out for comment, a proposal that would in part set the G fee based on state policies having to do with the costs of foreclosure in different states. As some of you may know, the time to foreclosure varies from 100 days to 600 to 900 days, depending on the state. Those are huge differences in the costs associated with foreclosing and taking action if people don't pay. Those cost lenders, and it seems to me to be perfectly reasonable and consistent to set the guarantee fees based in part on the cost of those foreclosures. I think the states that have been really behind in doing this have been kind of mistaken in their policies. States that allowed foreclosures to happen early and there were fewer impediments, once you've gone past the idea of a modification working, are some of the states that we've seen some of the recoveries taking place. And so I think that helps the market function better, but it's extremely expensive for lenders if you can't get collateral for 1 to 2 years after somebody isn't paying and after you've offered assuming the modifications have done appropriately. And it seems that risk-based pricing ought to be a part of any system.
Well, I think we have to consider, if we go down that path, what does that mean for the potential for a housing finance securitization system going forward. Now, on the one hand, you can see why FHFA and others will react to local and state governments having what you might call anti-investor, anti-market, or anti-insurer. These are insurers' steps. So when San Bernardino steps up and says that they are going to use eminent domain to take value, and this is a taking or not, obviously it would all the way go up to the Supreme Court if it were in place, and FHFA puts a warning out there and say, if you do this and if others do this, then it's going to in fact shatter the national housing finance market, and we may take steps. That's one thing. Because you can imagine if we had a fully private market and we had every locality having its own policies, well, would a pension fund in Norway, and believe me, we are dependent on global capital, including pension funds, sit down and evaluate every municipality's policy? So that's not going to happen. So having the reaction quickly in place that this is not a way you want to go. On the other hand, to go that way directly yourself, which is what this proposal, it's just a proposal being discussed, that in fact we ourselves are going to start pricing markets very differently. So the question that it raises, well, this is part of the risk, obviously, and in the short run, again, it's a reaction to, as Chris has said, different policies that have different impacts on insurers and investors, and the short run is one thing, but then let's think about the long run and the baby in the bathwater and our national housing finance system. If you go this way of risk-based pricing, then, I mean, really the risks are far, far more severe on simply the volatility of some markets. So how do you price Phoenix going forward? Is that 200, 300 basis points more simply because it's a much more volatile market? Or California? Is that going to have mortgage rates 200, 300 basis points more because it's a far more volatile market? Or Miami? I mean, where are we going with this discussion? Or are we having a discussion of this? It seems to me this is the level where we have to have the discussion.
I think your point is a good point, Susan, which is there are other factors in addition to state policies that probably should be priced into mortgages. In fact, lenders should have been pricing mortgages in Las Vegas in 2006 at a higher rate.
But that's, of course, the whole point of securitization is to have diversified pools. And as we all know as finance professors, idiosyncratic risk can be diversified away. Now, the question is, there's this gray line here. If it's 1/3 of the market, it's no longer idiosyncratic risk. If it's 100% of the market or 90%, and that's what was happening in the bubble, we have to be aware of what that
But it's not idiosyncratic risk. It's known risk. And if your expectation is that by giving credit at the same terms in a market where prices are way too high, an efficient lending market of which securitization is supposed to generate an efficient lending market, an efficient lending market would differentiate between the risks. And we know in other markets, in CMBS and other functioning markets, you look at different properties and you price different loan to values and different interest rates, and they can still all be pooled together. So you're supposed to appropriately price risk.
With all due respect, I actually have to agree. In normal functioning markets, and I have to put the emphasis in normal functioning markets, the default rates and foreclosure rates are so slightly different. So the important thing that we have, the important mission that is in front of this nation is to get back to markets that function well and normally. And then these risks do go back down to the very small differential levels.
Travis Lumpkin with Gordon Thomas Honeywell. I'm glad that the issue of GSE fees came up. One aspect, though, that hasn't been addressed is the fact that Congress is looking to capture revenue from increased G fees and actually use it as to pay for the temporary payroll tax cut extension the early part of this year. As we look at fiscal reform, what impact does future congressional action in this area do to delay reform of the GSEs?
They already did it once.
Yeah.
Am I right?
Yes.
They've practically guaranteed GSEs staying in place for 20 years, I think it was, with the tax. Pardon? With the tax that they put on it. So yeah, there is always that risk.
I mean, I think, it's just the argument for why do we want to pull the government out, because for as long as we can remember, politics have driven policies about the GSEs, not what makes sense for a market functioning. And so that's why probably all of us agree that we want to significantly reduce the government footprint in this space, and particularly reduce the role of regular congressional action to push these things for that reason.
But the interesting thing here is that the political support largely comes from the fact that many argue by raising the fees, it helps to bring government out and private capital back in. So as they look to make these changes, I think it's in the line of kicking the can down the road, just another reason why in fiscal reform, this might be a real threat to really tackling GSE reform.
So among the things that has to happen when we do these reforms is that they have to be thought about systemically, including FHA along with Fannie and Freddie. And one of the beauties of where we are budgetarily is that the Fannie, Freddie, the G fees are treated different budgetarily than our FHA. And as a result, Congress can capture them and count them as revenue, whereas the appropriators get to grab the FHA ones. This is all just nonsense and horrific and ought to be fixed the first chance we get.
Any lingering questions in the audience, or? All right. I think then we will invite our next panel to come forward. Nick Timmeros, my colleague at the Wall Street Journal, will introduce those guests. And I thank you all for this discussion on GSE reform.
I'm going to have to ring it on MI.
Good morning. Pleased to call up the last panel. Joining me on stage will be Ronald Haney, Executive Vice President of the ICBA Mortgage Services, Jerry Howard, the CEO of the National Association of Home Builders, Mark Zandi, Chief Economist at Moody's Analytics, and Jason Gold, who you heard from already, Senior Fellow for Financial Services at the Progressive Policy Institute. So before we launch into this discussion, I thought I'd ask a few, and you can just raise your hand or give a yes or no answer to these questions to kind of survey the experts here, maybe set the stage before we launch into this discussion. How many of you guys think that it is a good time to buy a home right now? I'm not talking about Flint, Michigan, but in places like Washington, D.C., perhaps, a good time to buy a home.
I do. Yeah.
I think it's a great time.
Yeah, absolutely.
Okay. Is it too hard to get a loan, to get a home mortgage right now?
Yes.
Yes.
Mark?
Yeah. Yeah. Standard
In general.
right. Yeah.
Okay. And do you think if you were a lender then, is it an attractive time to make a loan and to hold the credit risk?
Yeah.
And maybe that one's harder to do as a yes or no.
I think it's a slam dunk.
Yeah.
I think it's a scary time.
Scary time.
Scary time.
All right, good. We have a little bit of, so So the reason I ask those questions is because it seems like everyone agrees that we want to get private capital back. You hear that from both parties in Congress. You hear that from the administration. Almost everybody agrees. But it seems people just don't want to put their own private capital out right now, right? We want private capital back, just not mine. What is it that is preventing private capital from returning to the market? And maybe, Ronald, I'll start with you.
Well, I think, you know, in the last panel, I think, covered it also extremely well. But, I mean, it's just a lack of uncertainty. I know with community banks that we represent, you know, they continue to make mortgage loans and put in portfolio. My answer to you earlier was that it was a scary time. And if you talk to any one of these bankers, they're going to say they're scared to death because of all the impending tsunami of mortgage regulations that are coming down. But in particular, you know, you have QM, and then now you have the Basel III Accords. Those two items right there just create sort of this nightmare scenario for folks. And so they're very cautious, very, very cautious. And when a lender is cautious and uncertain, what's the natural reaction? The natural reaction is you pull in, you make your credit box tighter, and you know, you make fewer loans.
And so they're worried about, is it what, litigation risk?
Litigation risk, capital charge, that a loan that they might think is certainly should be, say, in bucket 1, if you're familiar with the Basel III Accords, and turns out, you know, it might be in bucket 2, and it might be, you know, 150% risk weighting. So very, very concerned about that, because decisions you make today are going to affect your capital position in the not too distant future.
Jerry, let me ask you, if this is a good time to buy a house, why is it that private capital, you see a lot of private capital out there doing REO to rental, you see private capital a couple years ago buying up non-performing loans. Why is it that private capital isn't getting back into kind of bread and butter originations?
Well, I think you have to look at it in a couple different ways, Nick, and you and I have talked about this. First, there is the lingering hangover of the last few years, and people are still very, very afraid in terms of real estate. Secondly, there is the fact that the regulations aren't all in place, and you have banks and bank examiners both pointing their fingers saying, he won't let me, he doesn't want to. That's holding things back. And then thirdly, you have, I think, the uncertainty with respect to government policy, where the government's going to go. And so everybody's sort of waiting on pins and needles. But I will also say that in conversations that we're starting to have, and when we're going to New York and elsewhere looking for capital, we're looking for acquisition, development, and construction capital, the front end of the pipeline. There are private capital companies that do see the opportunity now. And the problem for them, it's sort of like the paste picante sauce commercial, where all the cowboys are sitting around the fire and they look at their salsa jar and they say, New York City. Now you have all these guys with all this money that are ready to invest, and they look at their potential opportunities and they say, Middle America. They've never been there. And they don't have the infrastructure, the contacts, the ability to monitor where their money's going, how it's being used, and when the paybacks are going to come. So it's really becoming now in our conversations with potential capital sources as much a function of their lack of knowledge of the heartland of America, the markets that are out there, and their ability to put the infrastructure into place.
Jason.
Yep. So I think, Nick, you actually started to touch on something that I think is important. And when we talk about private capital, usually people kind of think of it as a single entity, and it's not, right? I kind of break it down into 3 large groups, which is depository institutions, institutional investments, which are pension funds, insurance funds, and alternative investments. And each of those has their own kind of frictions to reentry in a large scale. Coming back here, whether it's banks that have legacy issues and uncertainty in regulations, a lot of the alternative capital has still a deep-seated mistrust of the rating agencies that happen, justified or not. And so I think it's important to kind of, when we're looking at these, think about they all require different things to get back in. It's not just one thing, one size fits all. And the last thing to do, and Susan actually brought it up, as I was going to say, was things not to do, like casting eminent domain type Johnson and go at it, and that's kind of how I'd phrase it.
Mark, with home
Can I
prices,
get my 3 cents on that?
yeah, no,
Yeah.
well,
Yeah.
and a little
Go
bit, to the extent that home prices are coming back, do we at least get some of the economic uncertainty rolled back? We still have all the things that these other guys have talked about, but what do you think is preventing, to the extent you can't use, well, home prices are going down as the reason anymore, what is preventing private capital from getting back into this?
Yeah, good question. So I agree. I think reason number one why private capital hasn't come back yet is just concern about the state of the housing market. I mean, the housing market has performed much better over the last 6 months, but there's still a lot of concern that this is sustainable, that we're going to see consistent house price growth, that credit quality is going to continue to improve. And I don't think that happens until we nail down some of the fiscal issues, which are going to be very important to the job market and then ultimately credit in house prices. And also, we still have 3 million first mortgage loans in foreclosure or pretty close. That's a lot of loans. There's 49.5 million outstanding. So I think we need to work that down a little bit more before people really feel comfortable that house prices are going to move north in a consistent way. I think we're probably 9, 12 months before the economics are right for private securitization, private lending to come back. The second thing, and I think this echoes what's been said, is the regulatory environment is still very uncertain. You're not going to securitize until you know QM, QRM, Basel III. It's just not going to happen. You have to get that nailed down, and it has to be very clear. That, all indications are we're going to get a sense of that over the next 3-6 months, but it takes a bit of time to kind of figure that out, work it in. So that's a good solid year away until I think we have that in the right place. And then the third thing is return. You need a higher return in the context of the first two things. And so that means you need higher G-fees and FHA insurance premia, I think, ultimately to now, that's a lever you can move up, and the faster you move it up, the quicker you can get private capital in. But ultimately, I think we're going to need to see higher G-fees and FHA insurance premium before the private capital comes in a big way.
How does the low rate environment that we're moving into an even lower rate environment, 30-year mortgage with a point, you can get 3% now. How does that change the equation for the return of private securitization? I mean, can these guys compete? Does it make it easier because people are looking for returns anywhere they can go now?
You want me to take that? Yeah. Oh, I mean, I think it's ultimately it's a spread that matters. I mean, so if you have a low cost of funds and you still can get the returns through the spread, I think you'll get securitization back. But I think your point is a good one, that in this low rate environment, this low return environment, that makes it more propitious of an environment for private capital ultimately to come back, because investors, they're clearly searching for yield. And if they feel like the credit risk is manageable, then I think that the low yield environment makes it more likely they'll start to enter in. Yeah.
So the three big regulations that have yet to be spelled out, and we'll try to take them one at a time here. Their QM, Qualified Mortgage, QRM, which is helpfully titled the Qualified Residential Mortgage, different from QM, and then the Basel III capital rules. With respect to QM, the goal is to make sure that lenders are providing loans to borrowers where they have a reasonable idea that the loan can be repaid. We don't have these exploding arms where a broker had a pretty good, or should have had a pretty good knowledge that if home prices didn't go up, the borrower wasn't going to be able to make it. But Ron, how concerned should we be that banks ratchet up standards or keep the, everybody here seemed to think it was too hard to get a loan, so keep these standards in place, particularly for people who have harder to document income, self-employed borrowers, people who are paid in commissions, who have uneven incomes? Could these rules end up shutting out from the market the very people that they are designed to protect?
That's a huge risk. And based on a lot of the discussions that have already occurred with the lending industry and the CFPB earlier on, this whole issue has been raised considerably, because anyone who's ever made a loan knows that your safest loan is the loan you never make. And of course, that doesn't get you anywhere. That doesn't serve the purpose. And lending is all about taking risk. And you can look at any borrower, and you can have two borrowers who have exactly the same credit scores, exactly the same income, and I guarantee you those loans will perform differently. They will perform differently over time. It's just the way life is. Things happen to people, and people adjust and adapt to them. Trying to legislate and design a credit box that is robust enough to not shut down the market, yet safe enough to make sure that if I make Fred Jones a loan, I'm pretty sure, and I do these 5 things, that Fred Jones is going to pay on time. It's going to be safe, and it's not going to be a product that, to use your term, explode on them. That's extremely difficult to do. If a loan is a secondary market loan, there's national standards for underwriting. You have national debt-to-income ratios. You have loan-to-value ratios and all those things. And that's what a lot of the secondary market, it all operates on. Loans that are put in portfolio from a community bank perspective a lot of times aren't quite as, let's just say, neatly done. You deal with situations where you have unique property situations. It's not the whole world is not a nicely laid out suburban development. There's a lot of unplatted land. There's a lot of interesting zoning, and you have your regular lots. You have your regular properties. All these things end up in a bank portfolio. And so, our concern, obviously, for community banks is that if you have a situation where every loan's got to look like a secondary market loan, you're going to cut out about probably 10% of the mortgage market easily, because these are loans that never make it to the securitization model, but they are vital in small communities across the nation. So, are we concerned about how these rules are drawn? Absolutely. And the last thing I'll say on this is the bigger issue overriding all of this can the CFPB create a safe harbor for lenders from litigation, or will they go down the rebuttable presumption of compliance route, which then basically puts that lender out there subject to litigation on every single loan that they make? That will have an incredibly chilling effect on the mortgage market.
Yeah, I think that, that's pretty interesting, and this is one of the regulations that just confound me and doesn't make much sense. I mean, we talked about it's hard to get a loan, but right now, like, the credit is actually tighter than the actual guidelines right now, right? And that's what the banks and the lending institutions are reading into it, and they've got put back risk from the GSEs and everything else they're doing. And I think this reinforces that kind of psychology. And this is the one that really confuses me and doesn't make sense, because I think that you'll have the same this will have the same effect as the putback risk. I think they'll read into every loan, and you will not get outside of the narrowest credit box.
Well, Mark, you wrote about this in the Washington Post a few weeks ago. I mean, what is your best case and then your worst case for QM? I mean, if they get it right, the best thing that happens, and if they don't, what's at the other end?
Well, I think they have to do 3 things to get the best case. One is the box has to be relatively wide to address the concerns that were expressed. And I think if you take kind of the outer bounds of what Fannie, Freddie, and the FHA do, that's a pretty wide box. I mean, you can even find Fannie, Freddie making 50% DTI loans with countervailing factors. So I think if that's kind of the benchmark, you'll get a box that is, in a normal, well-functioning housing market, able to originate about $1 trillion a year, which is probably roughly right in the current environment, current context. Second thing is, I think you have to have, I do think you need bright lines. I mean, I think that if they're fuzzy, then it just confuses the matter. These concerns about uncertainty will prevail, and it'll put a pall over the market and make it much more difficult for the market to really get going. And then the third thing is, I do think we need a safe harbor. But there is a tension For a safe harbor, you have to have things more clearly defined, and you may knock some things out of the box by your definition that, you know, a reasonable person looking at it and spending time on it would say, okay, that's something that's worth doing. But I do think that it's better to have a safe harbor because the risk of making bad loans, outside the box is pretty low because I don't think you're going to see many people, going outside the box. So if we do those three things, I think that's a pretty good QM rule. I think that will lead to a healthy mortgage and housing market. And frankly, I think that's the most likely scenario. I'd be actually at this point surprised if CFPB doesn't come pretty close to that. Worst case is almost the opposite. Narrow box, fuzzy lines, no safe harbor. I think then we're in a world of we're in another world. We're not going anywhere fast because lenders are going to be totally confused and lending is going to remain tight.
To maybe play devil's advocate here, some of the consumer groups have said, well, you need that. You can't have a safe harbor. You need that threat of litigation hanging over lenders' heads so that there's some real accountability there, because we didn't have very much of that this last go around. There are still actors who are, their goal may just be to try to sell a house, right? Get those new homes off of the lot. What happens after that really isn't something that they're all that concerned about. So Jerry, I mean, is that a fair point that there hasn't been that much accountability, and that we need that because there's just not an alignment of interests?
I think the brighter the lines are drawn, the less there's a need for a safe harbor. But what's important to understand, I think, is that you're now talking about, by comparison to during the housing boom, a pretty vanilla mortgage product. You're not talking about the exotic mortgages and the lax underwriting standards that we had back during the boom. And so some of this is just a blatant overreaction to that. If the lines are drawn brightly enough, the safe harbor isn't needed. But also everybody needs to understand that will limit the number of people in America that will be able to buy a home. And if that's what you want to do, it's easy to accomplish. If you still want to promote home ownership across a broader segment, then the line has to be a little more fuzzy and there has to be a safe harbor. That's the basic fundamental public policy question here.
I think I sympathize with the consumer group's concern. It's a reasonable concern. But I don't know that the answer is the appropriate one to get to where they want to go. Because if you don't provide that safe harbor, then I don't think you're going to get much lending, at least for a long time, to those groups that they actually want to help. So I'm on board with the sentiment and what they're trying to accomplish. I agree with that. I'm just not so sure that they're right about the policy prescription to get there.
Yeah. The other thing too is that with that rebuttable presumption, that you actually create a scenario where, because I know some of the arguments have been, well, it'll be difficult for someone to bring an action. There won't be that many lawsuits, et cetera. Well, if you start to look at this, some of the discussion has been along the lines of an attorney. If a borrower goes to an attorney, they're pretty much obligated to bring this action because there is this legal right that they have to challenge the lender. And obviously this is going to happen most likely in the worst case scenario when the borrower has either lost their job or something's happened and the borrower can't pay their loan. And they probably can't sell their house. So, and so you create a situation where there will be a lot of litigation simply because by having that rebuttable presumption, there is that sort of private right of action there.
And so QM is supposed to get done at some point this year. Mm-hmm. In fact, the Dodd-Frank statute has a fairly onerous version of QM that kicks in if the CFPB doesn't get this out the door by January. After QM comes the QRM, again, the qualified residential mortgage. The goal of that, as I understand it, is to return some sort of discipline to the originate to distribute securitization world. But in the context of getting private capital back into the mortgage markets, I'd ask the panel, to what degree is private capital at a disadvantage if government-backed securitizations, so FHA, Ginnie, or any Fannie Freddie type successor, are not subject to these rules?
Well, I'll take a crack at it. So I think QRM should be defined. QRM does put folks outside the QRM box at a disadvantage. There's a cost disadvantage. And depending how QRM is defined and how premium capture, which is another aspect of this to try to avoid cheating on QRM, the risk retention, depending on how that's defined and articulated, it could be, the cost could be quite significant. And you would knock some mortgages out of the box. They would not be, you couldn't make them, you couldn't originate them. So a lot really does depend on the details here with respect to how this is defined. I think the way it should be defined, though, is that roughly 2/3 of mortgages should be Fannie, Freddie, FHA kind of QRM. They are QRM. The other third is non-QRM. And I think that's really important because at the end of the day, I think when we have mortgage finance reform, the catastrophic government guarantee is going to be defined by QRM, essentially.
That'll be kind of the new conventional loan standard.
Exactly. So if we look historically at the mortgage market back since the Great Depression, roughly 2/3 of the market has had some government guarantee, some government backstop. And I would argue that we've made mistakes, but in general, the mortgage market has functioned reasonably well. It's provided mortgage credit in good times and, most importantly, in very bad times, and kept the housing market together. So I would argue that we want something that gets us close to that 2/3. So we need to, when you think about the rules and how they're defined and how they're implemented, I think we should think about it in that context. So QM is pretty big, about $1 trillion market. QRM is 2/3 of that, so 650, 700 billion will be backstopped by the government in some way or another. And I think that would work reasonably well.
Any other concerns on QRM?
Well, from our perspective, again, you put the QM into place and you're going to limit the risks to the banks, and that's a laudable purpose. But again, that in and of itself shrinks the market to some extent. You put the QRM in place and you limit the risk to the government entities, it has a double effect of shrinking the market yet again. So you're making very, very important public policy decisions about how big the housing market should be and who should be able to buy a house. And eventually, the consumer groups are going to say, the very consumer groups that are advocating for some of this are going to say, now you're in effect redlining against certain segments of society. So I think it's really important that you hit the balance that Mark's talking about and maybe be a little bit more liberal with it.
Jason, what prospect do you think there is if these rules come out in a way that a lot of people are unhappy with them, lenders, community groups, so forth? Could the 113th Congress come in and take another bite at Dodd-Frank by trying to water down some of this stuff?
Not good. I think, look, that's a big aspect we haven't talked about. Aside from regulation, but just kind of reforming the whole housing infrastructure that we're going to need to do, and we're at a fundamental disconnect with Congress, right? It's not just politics. Both sides really disagree on how they see this, and right now it's shaping up. I don't see anything in the next election that's going to change that. So, I still think when you're going to have a divided Congress, they're going to try to address that, but I don't see how they're going to uniformly get anything done. It's just a disagreement on how they see the rules and regulations under Dodd-Frank.
And then the third piece that we talked about, Basel III. These are pretty detailed technical capital standards here. And Ronald, maybe I can ask you, what are the trade-offs here? Particularly as it pertains to, could we end up with a regime where it's more attractive for non-banks to get into the mortgage sector because the regulated depositories have much more stringent capital standards?
Oh, I think it's a real possibility. Obviously very concerned about that, and obviously we're raising those issues to the regulators quite loudly. And I think what you do there is you kind of set up a situation where one of the one of the, I guess, reasons for the collapse prior, most recent collapse was because of a lot of non-regulated entities participating in the market, and obviously, they could do a lot of things that a bank couldn't do, and we got into this situation. And so you really don't want to set the stage for, we go through all this pain and agony and regulation, and we end up right back where we were before. So we're very concerned about that. The other thing, too, is just that, looking at, where do you get capital from? And obviously the securitization market has been, in many ways a godsend for the American housing industry, simply because the ability to, to have a liquid securitization market is just outstanding. There's not enough bank capital to hold all these loans and balance sheets, not in this country. And so, covered bonds was discussed earlier. Hey, that's an alternative. There's some issues with covered bonds, but that could work. You've got bank balance sheets that obviously have capacity, but you've got to address the uncertainty around the QM rules, as well as you've got to address some of the issues with Basel III. So it's not unattractive for a bank to hold a loan in portfolio. So, and then the securitization market and QRM is, to your point, Mark, I think is huge. You've got to get it right.
There hasn't been a whole lot of attention yet on Basel III as it pertains to mortgages. I don't know, Mark, if you have any ideas here on what, are there issues lurking beneath the surface that people haven't focused in on yet that could be, landmines for the mortgage market?
No, I don't think Basel III is going to be a binding constraint on the mortgage market. I mean, it is going to limit bank lending, balance sheet lending. But banks are 10, 15% of the market in a normal market. And I think the banks are generally up to their eyeballs in mortgages at this point. And they're not really interested in expanding their balance sheet in general. Maybe this becomes an issue down the road, 5, 10, 15, 20 years, I'm not sure. But for the foreseeable future, I really don't see it as a binding issue. If you look at the bucket one, it feels like a crude form of QM, when you look at it. It's not too far off. It's crude in the sense that, it's not, there's very clearly defined DTI and LTV and so forth and so on. But, so I don't think there's a landmine out there. There may be, but I don't think it's I don't think it's going to be a significant binding constraint on the mortgage market.
Well, what about on servicing? Because there are caps on, the amount of servicing that can be held for capital.
Yeah, that's a good point. And one consequence of that may be breaking apart some of these big servicers, right? Because they can't hold, I think it's above 10% of capital. That may not be a bad thing, to tell you the truth, because the mortgage servicing industry is very consolidated, and as we know, this is creating a problem in the mortgage market. The Fed's QEing, driving down mortgage rates, secondary rates, but it's not translating quickly through because the market's very consolidated. I think there's a real issue there. So maybe this has the potential of breaking that apart and making the market a little bit more competitive.
I would respectfully disagree on the issue about Basel, because it actually drives through to the private market. If we have any hopes of creating a private securitization market, one of the things about Basel III is if you're going to hold a private mortgage-backed security in portfolio, you've got to know the underlying collateral, and you need to understand the LTVs and the makeup and the credit profile of those loans that make up that security. And of course, obviously, today with some of the disclosures that are out there, that's been a huge challenge. Obviously, a lot of things that we've seen come forward on hopefully remaking the private securitization market would have better pooling and servicing agreements and more disclosure. But the effect of having to have that kind of knowledge to be able to drill down to make sure that you've placed that security in the right bucket is a big issue. And again, depending on who you want buying these bonds, if it's community banks, they don't have the technology to do that. So I see that as a huge showstopper, or at least it'll put a couple speed bumps along the way in the road of bringing back the private market.
Nick, one of the things that when you look at kind of what the common denominator in all these is, income, credit, all that stuff is kind of straightforward. But the bottom line on all these things is really down payment. And when everybody talks about reform and regulations, it's always about the distribution of debt, right? And one of the things we've tried to do is talk about reforming the way, the other side of the ledger, which is the way borrowers save. And Mark, I've talked to you a little bit over the years about this. Like one of the proposals, I'm not saying this is the right one, just one of the ones I've come up with is.
That makes it right.
Thank you. So we call it the Home K, which is to have first-time home buyers have the access to a down payment savings account in a tax-preferred way in their 401k, so they can save at the same time for retirement and down payment. And it's just another way that really, it's a middle-class solution, and it's not an across-the-board solution. But the idea is that if we empower and bring in borrowers and build a pipeline that are coming in with stronger down payment situations, private capital is going to be more apt to also lend to more favorable LTV conditions.
Right, because at the end of the day, down payment's kind of the first line of private capital in the whole transaction. Now, to do that though, because we have this whole fiscal cliff tax reform issue coming up, having even more of a subsidy maybe or tax provision for housing could be a tough sell. So I'll ask about the mortgage interest reduction. Do you think it would be, if we're going to get this, do we say, well, you know what, maybe we don't need to have $1 million mortgage interest reduction. Maybe it can be $500,000. How much of incremental dent in demand is that really going to create? Are millionaires going to, people no longer going to want $1 million houses because they can't claim the full benefit of that deduction?
I'm not going first on MID. Sorry.
Well, Mark, I'll put.
Yeah, thank you.
Yeah, you guys. I'm glad you guys are sitting right next to each other, Jerry and Mark, because I know you guys.
We know each other's views on this.
There you go.
Yeah. Well, all right, I'll get in trouble. So I think it's pretty straightforward. You want to limit or eliminate the MID on second mortgages, on second vacation homes, and maybe scale it back for high-end homes. I think
clear to who?
To me. Yeah, to me. And that doesn't make me right, I know. More broadly, I don't think the MID helps the housing and mortgage industry as much as the industry thinks it helps them. At the end of the day, it probably jacks up house prices in some markets 5–10%. I don't think it's much more than that. I think if you slowly partially phased it out over time, the impact on the industry would be not meaningful in terms of housing transactions, in terms of housing construction, and ultimately in terms of house price growth in the future. And I do think that it's costly. It's $100 billion a year. We need to fix our fiscal issues. If we can scale this back by, let's just say, half and generate $500 billion in revenue over 10 years, that's consequential. It addresses our fiscal issues. And I would say to the industry, no industry is going to get hurt more if we don't address those fiscal issues, because it's going to result in higher interest rates, and this industry is going to get creamed. And moreover, the final thing I'll say is I think this industry has benefited enormously over decades from government and taxpayer support. And that's clearly evident in the financial crisis. And I think it's time for the industry, and I would counsel the industry to give back and lead the way. We need someone to lead the way and give up something that is obviously they think is important to them. Because once one group does that, and this is a very important group, obviously, to the politics of this nation, then we're going to see other groups follow, and good things will happen. But we need someone to lead.
And to the point you made, before I give Jerry a chance to jump in here, on scaling it back over time. The UK did this 15 years ago, right? They did this over a 15-year period. Did it have any kind of calamitous?
Well, I'll say one final thing. You ask any economist, almost any economist, ask Doug. Yeah, ask Doug. What they think, you know, whether the MID really is a benefit to the housing mortgage market and the economy, and you won't find many saying yes.
I'd rather ask Dave Crone.
Doug? And one reason why economists believe this is they look across the globe and, you know, they ask, well, where's the evidence that this really is helpful to the housing market and in transactions, home ownership, you know, you don't find the evidence of it. So, you know, if I were going to pick one thing, if I were the industry and I were going to pick one thing that I'd be willing to give up so that we can address our fiscal problems, because again, the industry is going to get creamed if we don't address these fiscal problems.
You mean
that
more
would be
creamed than we are now?
Yeah, absolutely. You haven't seen the world of hurt we're going to be in if we don't address these
You
fiscal
haven't seen
problems.
the world of hurt we're in now. We can't afford to have anything more done to this industry if you want to have an economic recovery, period.
No, I'm not, Jerry, I'm not arguing today. I'm not arguing tomorrow. I'm not arguing next year or the year after. I'm arguing 10 to 15 years down the road. Just phase it in over time.
Well, let's come back in 10 to 15 years, but let's stop talking about it now because you're creating uncertainty in the marketplace. And it's an uncertainty that we can't afford. And I'll give you, my classic example is, you and I are baby boomers. Before the Tax Reform Act of '86, probably. Before the Tax Reform Act of '86, we were encouraged to buy as many houses as we wanted, right? There was no limitation. And we did. And all of us built our nest egg around housing. Now when we're getting ready to retire, they're talking about doing away with it for second homes. And by the way, second homes is a pig in a poke. There's no money there, folks. It ain't there. But you're talking about doing away with it for second homes? A lot of baby boomers invested in second homes. They're going to use them for their retirement. So it's going to make it more difficult for them to sell their primary residence, at least in the near term. It's a bad idea to be talking about this right now on any level. You can't find a cap, by the way, a reduction in the cap that will fit every housing market when we have a fully functioning market across the country. So you're going to have people in Southern California saying we can't live below $1 million, and voters in Nebraska saying we can live with $500,000. It's impossible politically to come up with that at any lower level. And then to go back to second homes, the largest single user of the second home deduction right now, does anybody know what it is, who they are? They're service people who are moving from one home to another. So we're going to exempt them. Now you're all thinking, oh, well, the rest of them are the people who have beautiful mansions on the beach in Hilton Head and ski chalets in Sun Valley. No, they don't take the deduction. They pay cash or they rent it out. The average American who uses a second home deduction as a second home is somebody who's buying a home for their retirement, taking out the service people, buying a home for a retirement, or it's a cabin on the lake. The state with the largest number of vacation homes in it is Michigan. So that's a pig in a poke. It's not going to get you anywhere, and the political pain you have to go through to get it, I think, makes it unpalatable. But most importantly, we're talking about a death by 1,000 cuts. QM, QRM, Basel III, raising the G fees, now the mortgage interest deduction. Do you want consumers to get back in the market, and do you think that the housing sector has to fully recover in order for the economy to recover? If you do, cut it out, because we're already creamed, Mark. And that's my story, and I'm sticking to it.
I knew I'd get in trouble.
Yeah.
All right. I knew I'd get in trouble. But it's your fault. It's your fault because you didn't take it. Because you would have gone down the same path I would have.
That's one of the sacred cows that will clearly, as we've seen, be difficult to get at. The other one is the 30-year fixed-rate prepayable mortgage, which, you know, for all intents and purposes, it's the North Star of our system. Dodd-Frank seems to make it even more difficult to walk away from that. But when we have a discussion about getting private capital back into the mortgage market, it raises the question: is that the best? I mean, should there be a public policy interest in promoting that mortgage, given all the other things it requires us to do in terms of creating a liquid securities market, having securitization, having a government backstop? It'll be very difficult, of course, to get rid of a government guarantee if we want to have that product out there. So in terms of public policy promoting this kind of a mortgage product, is that something that the government should do? Maybe I'll start with you, Ronald.
Really? You're pausing?
Yeah.
What the hell? This is news.
This is news. I mean, I think I think that we would not, clearly we would not have the housing market and the mortgage market that we have today if it wasn't for the 30-year fixed rate loan. And quite honestly, when you look at any group of borrowers, what do they prefer? 30-year fixed rate loan. And why is that? Because it's certain. I know what my payment's going to be every month. I can budget around that. And people, that's how you live. You live, okay, I know I got to pay this for my house. I got my car payment, et cetera. I can plan, and it provides certainty. And so markets work well when there's certainty. The government subsidy of it, well, the reality is that a 30-year fixed rate loan, can be done without a government subsidy. It absolutely can. Obviously, the cost is going to be considerably higher. Because loans were securitized, you sold off the interest rate risk to somebody else, you hedged your interest rate risk. From a portfolio perspective, it is not a great product. That's why you see most portfolio lenders invest in ARM loans or and I know this has become an unpopular product of late, and that's balloon loans. But a lot of community banks, that's what you do. They do 3- and 5-year balloon loans all day long because they can match fund those loans. The borrower comes in at the end of the balloon period, refinances the loan. Maybe they can get a 30-year fixed rate loan that's being sold to Freddie Mac or Fannie Mae. But it is a way for people to finance properties. I think it's tough. I don't think the American economy is ready for a world where there is no 30-year fixed rate loan without a government subsidy or a government backstop. I believe the Fannie and Freddie provide a valuable role, and to somebody's point earlier, it worked pretty doggone well for a long time, regardless of all the other flaws and things that could have been done better. And so it's sort of like, do you throw the baby out with the bathwater? And I don't think we do. What that guarantee looks like in subsidizing the 30-year fixed rate loan, I'm not sure what that is today, but I think it's something, to Jerry's point, if you take that away, you've really creamed the market.
So, Jason, do you think we could have a 30-year prepayable loan without a government guarantee?
Not widespread.
Without a TBA?
Not widespread, not affordable. No, not widespread access.
Does anybody here disagree?
No, that's right.
So what does that mean for getting, that clearly, there's a view right now that we can get rid of government guarantees for housing, right? We've heard, kind of the Hensarling proposal has been to wind down Fannie and Freddie and Scott Garrett. We don't need a guarantee. Is that taking us into kind of a, mortgage market we haven't had before?
Yeah, and probably not one that works real well. I think the essential question is, people want that. That's what they want. And so that's okay. Look, everybody always says, well, look at Canada, and we're not Canada. Yeah. And Canada has full recourse. We don't need to look and keep up with the Joneses. We are the Joneses, right? And it's okay to kind of make the market. We want affordable, widespread, fixed rate loans. We want housing, and there's going to be a cost to that. What you do is we need to try to figure out what's the best way to incorporate those costs that it promotes economic growth and it works well with our economy, and not just try to pluck it out and see how far the market falls.
Yeah, I think there's an economic case for a 30-year fixed rate mortgage, and that is you want the interest rate risk in the financial system. You don't want it in households. I think it's a more efficient system and ultimately to the benefit of everyone. And you can manage it better in times of crises. As we saw during the Great Depression, we did go down the alternative path, and it cost us dearly. So I think it's worth, the 30-year fixed rate mortgage is a good product. It makes our system better. And we can price it properly. I don't think we should use the word subsidy. It should not be subsidized. The government guarantee, the catastrophic government guarantee, should be properly priced, actuarially fairly priced. And it's not that costly because they're guaranteeing the tail of the distribution, and you can do that in a way that isn't too costly. It doesn't add too much to the basis points of the cost of a mortgage to a homeowner. So it's not a subsidy. It should not be a subsidy. It should be actuarially fairly priced, and I think at the end of the day, we have a better system with a 30-year fixed rate mortgage.
Do you think the government can get guarantees right? I mean, clearly with Fannie and Freddie, that didn't happen. With the FHA, they've been trying to play catch up and you know, to some degree outrun their own legacy book here. How comfortable are you with the government being able to appropriately price that guarantee?
I'm comfortable. I'm comfortable. I think the FDIC does it with deposit insurance. They've done it right. You know, we need to design it so that if things go badly wrong and the government misprices the risk, there's clawback provisions, just like the FDIC. If they can't cover the deposit insurance fund, they can go back to the banking system and say, listen, you got to ante up and cover the losses. So you can design this properly. TRIA, that's the terrorism reinsurance. That has worked, I think, well and properly. We can do this right, and I'm very confident that we can and get it right. Now, Fannie and Freddie, that was that was set up in a way that was a problem. We all knew it was a problem.
But that was, I mean, private capital was kind of the goal there, right? Well, we're getting private capital into this.
Yeah, but we knew we were implicitly subsidizing. Everyone knew it. In this case, we are saying we're explicitly pricing. We're not going to. There is no such thing as an implicit subsidy here. I mean, that's the system I would advocate for, and I think ultimately that's the system most people are on board with.
I mean, I think Mark's right. I mean, one of the things that drives me crazy is Fannie and Freddie now are not really what Fannie and Freddie were 7 years ago. They're two entirely different animals, and I mean, they're making money now. They're doing it now. They're just too big of the market, and we need to figure out how to bring in the private capital, which is what we're talking about. But I mean, they're doing it now. I don't see why they're mispricing unless
no, they're making a boatload of money.
Right.
In fact, that's going to be a problem. They're going to make so much
Congress
money.
is
It's going to be hard to right. Can't get rid of them. Yeah.
Right.
Though we still don't have very much private capital. I mean, in the rest of the market, you've got the Fed buying and.
It's coming. It's coming. You can feel it. It's coming. We go back to where we started the conversation. You need to nail down those three things, and it's coming.
What is we hear a lot of, so there's kind of a bipartisan consensus. We want private capital. We also hear we want to have a counter-cyclical market where there are loans being made during down periods. Is there any, what would be the best way to try to ensure that for one, we continue to have a counter-cyclical lending environment, but also that lenders don't get amnesia 5, 10, 15 years from now once things begin to look good again, and you try to lay off as much risk on the government as you can and take as much profit for yourself?
It seems oxymoronic to think that you're going to have a counter-cyclical lending environment and not have the government involved. Private capital simply isn't going to get in there in a downtime. So you have to make it work, Nick. And how can you do that? By going back to the fundamental model that worked so well until 2006, 2007. And that is to have sound underwriting standards, to not push the envelope too far in terms of the exotics and trying to get people in housing in home ownership that aren't ready for it. And if you do that, you go back to what worked, and it'll fall back into place. And I agree with Mark, it's coming. The very bankers that laughed me out of their offices 3 years ago when I talked to them about putting AD&C money into housing are now trying to work out the logistics with me. They want to get back in. The fundamental market elements are right.
Actually in Basel III, there is LTV, right? I mean, to some degree, through the capital standards, you are counter-cyclical because of the different risk weighting on the LTV. But I think broadly, counter-cyclicality should be addressed through broader capital standards. So if you said to me, as part of the capital standards, we had cyclically adjusted capital, meaning aggregate credit growth was rising very rapidly relative to economic growth, then capital standards would have to rise in that context. Maybe. But I don't think it will work to do something like that by targeting mortgages or credit cards or ADC loans or whatever it may be. That I think is a step too far.
And finally, before turning it over to audience questions, one overlooked source of private capital is mortgage insurance. And obviously, the mortgage insurance industry has been through its own share of stresses. Do investors still trust mortgage insurance? Does that model still work?
I think it's critical to have it. Now, whether investors still trust it or not remains, I can't speak for them, although the mortgage insurance industry has paid out a lot of claims, which has driven a couple of companies out of business, which is an entirely different issue, I think. But and it's the ones that are remaining standing are kind of bloodied a little bit, but the fact that it does work. They come in, they pay claims, they put their capital at risk, and things go bad, they have to pay. And so, yeah, I think mortgage insurance is a critical component to a successful housing market, and especially in looking at the proposed capital regs. That was a huge concern of ours when we looked at the Basel III regs, that it didn't give any credit for mortgage insurance at all, and that's a problem.
With that, I'm sure we have lots of great questions out there, so there are a couple mics.
Can I ask a question of my fellow panelists, because
I'm
a little confused about Basel III. It's my understanding, I have two potentially problematic questions. The first is, it's my understanding that Basel III is a voluntary international agreement, and that many of the other countries that have been engaged in the negotiations don't intend to enforce it in their countries. So my question is, why the hell should we? And the second question I have is, Basel III, as I understand it, is aimed at internationally active banks. Why would we, if we are going to enforce it in our country, enforce it on small community banks that are the heart and soul of small business lending in middle-class America, and therefore the key to the economic recovery?
I've already gotten in trouble already, so.
In for a dime.
Well, no. I barely help myself.
I mean, would anybody here argue that banks had too much capital going into the last cycle?
There you go. Listen, I'm gonna look. Why the hell should we participate? Because we want a sound global banking system. Because what happens?
If they're not participating, I guess it's a fundamental question. Are other countries going to enforce it?
Some will, some won't. But I think it's in our best interest as a nation to lead the way on this. That what happens in Europe, what happens in Asia, what happens to Itaú in Sao Paulo, Brazil, is going to hurt us and affect us. And we have to lead the way on these issues to show them that this is the proper way of doing it, the appropriate way of doing it, and ultimately it's going to be in their best interest of doing it. If we don't do it, Jerry, no one's going to do it. And then it's going to be a free fall, and we're going to pay for it.
But Jerry, I'll chime in here. It makes no sense for it to be rolled down to community banks. I'm sorry, the bank that's lending in Glenview, Idaho, population 456, it's not systemic to the United States. It's obviously systemic to that community because they're the only lender in town. And if they can't make a loan to their local builder out there to put a house on a 35-acre lot that's not a farm, and put that loan in portfolio and hold it without having to have it risk weighted at 250%, that's a huge problem because your guy's not going to be able to build that house, and our banker's not going to be able to help that member of that community. And it's a small community, and no one else is lending there.
Okay, so I'm batting 500. I win the batting title.
Any questions from the audience? We have one over here.
Judy Kennedy, National Association of Affordable Housing Lenders. I would really encourage Mark Zandi to look closer at Basel III, which has a formula of not just requiring the bank in Cedar Rapids to follow international rules, but to differentiate its mortgage lending capital requirements by down payment in 8 different buckets. That requires more capital for mortgages than for credit cards. That increases the cost of that bank if it finds a multifamily acquisition, development, or finance opportunity by 50%. I mean, the proposal clearly looks punitive and works against the notion of diversification among financial institutions. And then add to that what Ron discussed earlier about the incredible due diligence requirement of buying a mortgage-backed security, the notion that you could be penalized up to like 2,500%. if you aren't following it on a daily basis. I think all of this is tremendously destructive of the housing market.
Yeah, thank you.
Thank you.
Any other questions?
Hi, Alan Zibble with Dow Jones. Back to the mortgage interest deduction, just to be devil's advocate. What if you took Mark's $50 billion savings per year on the MID and used it to fund Jason's home K plan? Wouldn't that actually be good for the builders? Wouldn't that be good for Jerry in that it would incent more new purchasers of new homes and actually propel home ownership rather than
If we were living in a vacuum, it might be, but you're talking about real people that are making real-time decisions about assets that they own now. You're talking about the savings rate of America as the baby boomers reach the retirement age. And, Alan, you're still talking about an industry that needs to get its footing in order for us to have economic recovery. And all of this tinkering right now, the time to do that is maybe when things are going well and you can afford a gut shot. Not when you're struggling to get off the mat.
I was going to push in the same direction, which is we're sort of, we get out of a sort of crisis which was driven a lot by sort of really inadequate lending standards and skin in the game that was particularly problematic in the United States. And it seems to me that programs that encourage that if we're going to push towards savings and push towards home ownership, encourage people, try and figure out how to help them get down payments to sustainably come in, strike me as kind of programs that are moving in a direction rather than the other side, which is reduce capital standards, reduce skin in the game, reduce all the kinds of things that sort of got us into trouble because we really want to help home ownership as opposed to taking a different approach. So I do think this idea that Jason has of trying to encourage savings through the tax code is helpful in the sense the tax code now encourages debt, right? You can write off debt, second mortgages on your home. So you actually, second mortgages essentially have legal protections because they're not clearly subordinate to the first that wouldn't exist in any other credit market, and that's partly protected by federal law. So in essence, the federal tax code and federal regulation have encouraged using housing for debt as opposed to encourage it for savings. And so it strikes me that this is exactly the right time to take on that question from a sort of political perspective, because we don't have people sustainably owning homes without taking on more debt, but with paying them down, we're never going to be able to fund retirement later on in the future, because these people are ending up in retirement with leverage, and it's a big problem.
Even if theoretically I agreed with you, and I'm not saying that I do, I think it's politically naive to suggest that in a tax reform environment, and I see some people in the room who lived through the Tax Reform Act of '86 with me, in a tax reform environment that a Congress is going to take away from housing and give back to housing. It just ain't going to happen. It's a nice, even if it was a nice idea, it's naive to think that you'll be successful in this environment.
Other questions? Great. Well, thank you guys very much.
Thank you.
Enjoyed the panel. Sorry, Mark.
So I want to thank Jason Gold and the folks at PPI. I want to thank Secretary Donovan, all of our panelists, our moderators, but most especially everyone in the audience for coming today. We are adjourned.